Good afternoon, everybody, and welcome to DNN, the Doomers News Network. In a world where the financial media has devolved into an endless stream of assurances that everything is fine and cheerleading for the financial system, somebody has got to call it like they see it and give actual boots on the ground information about this economy that doesn't just serve the interests of the financial system, but actually tells it how it is. And that is what we are striving to do with this channel. And with that, I'm going to turn it over to my buddy Travis.
All right. Thank you, Jack. And we wanted to let you guys know as viewers that today we're going to have 7 different stories. Each of us is going to tell a story. Now, the first story is going to be basically, how the retired are preventing a financial crash. The second story is going to be quite fun. We're actually bringing in some guests to talk about Case-Shiller and whether or not Case-Shiller is actually useless. Maybe it is, maybe it isn't. The third story is the history of the housing market crash and presidential election. I'm looking forward to that one. Fourth story, you guys, is the buy now, pay later financial disaster. We're going to go into that. Fifth story is going to be the hidden warning as far as private note sales. Melody has actually recently got some boots on the ground intel that she's really excited to share with you, not to put words in your mouth, Melody. Sixth story is going to be the new home construction scheme. Maybe scam, I should change it, but a scheme. You guys, last week was big. We had a lot of crazy things happen last week, so I'm really looking forward to that. Now, we're actually going to add a 7th video. So today's podcast is going to have a 7th video. We're going to have the 7th video as our last video because it gets a little bit, it's a little bit political, you guys, and we want to be very, very careful to basically explain to you how we don't want to talk about Republicans or Democrats. We just want to report some of the political things that are going on that are impacting our economy. So that's what's going to be going on today. And don't forget, you guys, like the video, share the video. We definitely appreciate you. And what we really want is we want you guys to gain awareness so that you guys can adapt, plan, and win. Now, today's story is going to start with Jack, and he's going to give us a story on how the retired are preventing a housing market crash. And Jack, take her away. You're on mute, buddy. You're still on mute. Jack, someone sent him a private message. Jack, you're on mute.
Yeah, rookie mistake. Buddy. Jack was on chat the whole time. The wonders of editing. There's no editing when you're live. Well, thank you, Travis. What we're looking at here is the red herring fallacy. It's a literary device. A lot of you are probably familiar with it. It's an argument that's meant to distract you from the real issue. And I did a little bit of reading about the red herring recently. And interestingly enough, you can trace the first use of the phrase red herring to describe a distraction to this guy, a early 19th century. He's described as a radical journalist from England named William Cobbett, who first used the term red herring to describe a distraction in description of a story where the defeat of Napoleon was falsely reported in English news in 1807. And it turns out that story was traced back to Napoleon's spies who had planted misinformation. It was really one of the earliest uses of fake news, if you will. And some fun facts about this guy, William Cobbett. As I was reading about him, he was a big proponent of the gold standard, which kind of resonated with me. He was radically opposed to Malthusianism, this belief that we need fewer people in order to prevent starvation and save the planet. It's kind of a line of thinking that's gaining popularity among the elites these days. He was also a big proponent of less government waste and lower taxes. So this guy, I was kind of digging this guy, although later on, Karl Marx kind of latched onto his work in his early writings of communism. So it wasn't all unicorns and rainbows here. But I found it pretty interesting. And the origin of the phrase red herring is actually, there's no such thing as a red herring. It's actually referring to this stuff, which are Scottish kippers, which is this very pungent smoked herring fish. And, it gets the name red because it's been sliced open at the belly. And they were used to train bloodhounds, train hunting dogs. And what William Cobbett used to do when he was a kid is to throw off the dogs in order to protect rabbits that he liked or things like that. He would drag one of these kippers or one of these red herrings through the woods to throw the dog's scent off. So that's the origin of the phrase, the red herring. It goes back to 1807. I thought that was kind of interesting. But we actually have a new breed of herring here. All right. And it's a newly discovered fish, and it is Herringus magatus, as you're looking at right here, or as I call it, the orange herring is what's being used now to distract everybody from what is going on in the world. We obviously had a big news in this subject this week. But I don't want to talk about that right now because, as always, when the magician is doing something with the left hand, you want to watch what he's doing with the right hand. And there was some things that were dropped in the news this week that, stand alone, any one of these maybe wasn't a really big story, but when you put them together, it's actually really scary. And that is what's going on with our pensions. And I think what's going on with this circus in the press is really meant to distract us from the fact that we are all being robbed blind in the form of our retirements. And that's what I want to show you here. And it started with this article on May 28th. It came out this week, just a few days ago. Slow moving property crisis means averting a greater one. Now, there's this phrase, extend and pretend, is going on in the market right now. Everybody's like, we all know commercial real estate is collapsing, right? We've all seen these stories of the buildings losing hundreds of millions of dollars. And yet we don't see banks failing from this. And we don't see these big financial firms going under. How could this be possible? How could we have this massive property crisis going on with all of these buildings and all of these skylines losing value, and yet it doesn't show up in the system? And for that, before we do that, I want to cue up my buddy Travis here. He's going to play a video for you guys from the movie The Big Short. And in this phone call, Christian Bale, in this first phone call in the movie, Christian Bale is talking to Goldman Sachs, and he's saying, look, guys, mortgage defaults are on the rise. How come my credit default swaps, my insurance on those mortgages aren't going up in value? The banks are lying about what these things are worth. So let's roll that video here.
You can't call me back for a week?
I'm so sorry, Mike. Goldman had a systems failure. I lost a ton of messages.
Yeah, B of A said they had a power outage, and Morgan Stanley said the server crashed.
Huh. That's weird.
Yeah, I would call it improbable. So, where do you have our position marked?
I think it's the same, Mike.
What? Can you explain that to me, please? Because how can the value of an insurance contract not be affected by the demise of the very thing it insures?
They're independent markets. They're not always correlated. I know it sounds odd, but these are very complicated products.
So what happened in that story is, first of all, he calls Goldman Sachs. They don't return his call for a week. The banks are ducking him, all right, because the banks are lying. They know these credit default swaps should be worth more money. They know mortgages are dropping in value like crazy. The banks are pretending that it's not happening because the banks have all of this toxic crap on their own books. And it's not in their interests to actually mark these things to market in other words, tell the world what these things are actually worth. And of course, Michael Burry, portrayed by Christian Bale, is just beside himself at how fraudulent and how just BS this is. And so I want to talk about this slow-moving property crisis. And, this is an article, like so many articles talking about commercial real estate, where they're saying, oh, the bottom is in. Every time you read about commercial real estate, there's one guy quoted saying, don't worry, this is the worst of it. But they've been saying it for a year as it continues to get worse. But there was one line in this article on May 28th that really jumped out at me. And I want to zoom about halfway down in this article. And they're talking about how there's suddenly more of an appetite for these commercial mortgage-backed securities, these bonds that are made up of loans to office buildings and apartment buildings and retail buildings. And in this line, they're saying this year through late April, investors scooped up $24.6 billion of CMBS offerings, 170% more than the same period last year. So this stuff is selling like hotcakes, even though these buildings are losing hundreds of millions of dollars every time they sell. Investors are buying up these bonds for some reason. And then they go on, and this is what really spooked me. They said this is allowing the banking system to offload some of its real estate risk to investors. Now, that right there is what really scared me about this, because you can't eliminate risk. All right. My buddy Joe Brown over at Heresy Financial, he says this all the time. Risk can't be eliminated. It can only be transferred. And so what they're saying here is all of these commercial mortgage-backed securities are selling 170% more than last year. So it's almost tripled. And at the same time, they're saying the banks are offloading real estate risk to investors. Now, who are those investors? You might be shocked to learn that those investors are you. You're those investors. We're not talking about Wall Street firms that are buying this garbage. It's you that is buying this garbage. While you're being distracted by the orange herring and everything going on in politics, your nest egg, your pension, your 401k, your IRA, which whether you realize it or not is heavily invested in this kind of stuff, these funds are buying up commercial mortgage-backed securities from the banks. The banks, which are not marking them to market, they're not saying what these things are really worth. They're selling them to you. And you get a little bit of detail on that in this article that was in the Wall Street Journal just 2 days ago. Commercial property meltdown clobbers pension funds. Now, just look at the difference in the titles here, right? Where a few days ago, they're saying slow-moving property crisis averts a greater property crisis. And then a few days later, they're saying commercial property meltdown clobbers pension funds. What a different tone the titles have taken here. Government retirement funds are selling property at a loss as the slump spreads. So while they're saying it's good that the banks are moving slow and offloading that risk to investors, the investors are getting clobbered in this stuff. In other words, they're socializing the losses to you. Government pension plans are getting hit by the commercial real estate meltdown, and many fear the bleeding is far from over. Canada's National Pension Plan said in May that it's selling stakes in the Manhattan and San Francisco office towers for $225 million less than it paid for them in April. California's government worker pension plan said it had unloaded a Sacramento property it had been trying to develop for almost 2 decades. In March, consultants warned that teachers' pension plans in California that the office holdings would continue to drag down their returns. This is offering a new glimpse into the widespread and slow-moving commercial real estate slump. They misspelled crash there, because those investments generally don't trade on public markets like stocks. There isn't an agreed-upon price. That's a key phrase there. They don't trade like stocks in public markets, and there's no agreed-upon price. So the banks can just basically say these are worth whatever we say they're worth. Of course, nobody's willing to buy them for that unless, of course, they're not buying with their own money, i.e. pension fund managers, private equity managers who are managing your retirements. Now, 2 years after rates started rising and 4 years after COVID, the impact of these events is spreading from U.S. banks with trillions of dollars in property loans and investments on their books to the retirement savings of teachers and firefighters. Exactly what they said in the last article. The banks are dumping this toxic sludge into your retirements. And there's stories after stories here going on with just telling stories about all of the losses taking place in these office buildings. Let me just give you a couple of examples here. Where is it? Give me 1 minute, guys. I have to find my notes here. The Canada Pension Investment Board said in a report that it had sold its stake in a downtown San Francisco office tower that once housed Uber Technologies for $44 million. CPPIB bought that stake in 2014 for $219 million. And the fund said it signed an agreement in March to sell its stake in a building at 10 East 53rd Street in Manhattan for $7 million after buying it in 2012 for $57 million. So just those two stories there about this Canada Pension Plan Investment Board, the CPPIB, they have lost $225 million on these two deals, an 82% loss on these buildings. And that's just one of the stories in here. All right, there's another one talking about this California pension plan. All right, the $493 billion California Public Employees Retirement System, or CalPERS. All right, they just took a 12% loss on this building in 7th Avenue in I think this was in San Francisco. All right, a more modest loss at 12%. But you're talking about pension funds that are tragically underfunded. And now they're taking these massive losses. They're talking about one property in particular here. In early 2000s, CalPERS bought this they bought this parcel of land, and they were going to build these two 53-story condo towers on this block in San Francisco. A decade later, CalPERS approved a different plan on the site. They were going to build an office condominium retail complex. It was going to be Sacramento's largest tower, but of course, not enough office tenants were ever found, and so they had to scrap those plans. In total, CalPERS invested $87 million on this plot. Then in April of this year, the pension fund said it had sold the land for $17 million to the Shingle Springs Band of the Miwok Indians of Placerville, California, a federally recognized tribe. So CalPERS took a $70 million loss on this plot out of an $87 million investment. That's an 80% loss. So, I mean, you can see here in these stories, these pension funds are getting destroyed in commercial real estate while the banks are selling more and more of this stuff into pension funds. They're using your retirement as exit liquidity. You're holding the bags, and the government is sitting back while it happens. And it's not just commercial real estate where this is happening in. We had this story this week. Canada's 9 Point halts cash payouts on 3 of their credit funds. Now, this is, instead of commercial real estate, this is zombie companies that had been unable to borrow any more money since interest rates went up. The banks will no longer lend to these zombie companies because they haven't had positive free cash flow in 15 years. And so the financial system has created this behemoth of private credit, which is basically just, instead of banks loaning money, they dip into your pensions and they loan money to these zombie companies. So these private credit firms make loans to these zombie companies, and then this private credit fund is sold into pension funds. Well, these companies don't make money. And so what Canada's 9 Point is saying here, hey, since we're not making any interest payments here, nope, we're not getting any of the money back from these zombie firms, we have to halt cash payouts on these funds. And those cash payouts would go into your pension. And so these zombie companies, their debt is now being parked on pension plans. And you can see it even here in this article in pensionandinvestments.com or PI Online. Private credit attracts billions from U.S. pension funds. So the takeaway here, guys, what's really going on in this story is your pensions are being used as exit liquidity for zombie companies that can't afford to borrow money in these interest rate environments. So instead, they're borrowing from your pension, knowing they can't pay it back. And already these firms are starting to have trouble. The commercial real estate, which is still sitting on most regional banks and small banks across America, those banks are not revaluing that commercial real estate. Instead, they're selling it to your retirement plans, whether it's an IRA, a 401k, or a pension. And then once it's off of their books, then we find out how much money they're losing, like we saw in that article about the pension funds being clobbered. And in closing, I want to play a second video, another phone call that Michael Burry, portrayed by Christian Bale, had with the Goldman Sachs people, but it was later on in the movie. Listen to what happens in this call.
Listening.
Dr. Berry?
Yeah.
Steve Winston, Goldman Sachs. Listen, I've been reviewing your position. I wanted to discuss your marks, make sure they're fair.
Yeah, I think you mean that you've secured a net short position yourselves, so you're free to mark my swaps accurately for once, because it's now in your interest to do so.
I'm not sure what you want me to say.
I think you've already said it.
So where in the first phone call, Goldman Sachs is saying, oh, these are very complex financial instruments and they're not correlated and our system broke down and that's why we couldn't call you back. They weren't fairly valuing the value of Michael Burry's credit default swaps because it wasn't in their interest to do so. All the while they were lying about what those swaps were worth. They were unloading their toxic mortgage-backed security debt, and they were buying those credit default swaps themselves to protect themselves from the collapse. And so it wasn't until after the bank had unloaded all of its garbage to unsuspecting investors, then they called up Dr. Burry and said, now let's talk about what this stuff is really worth. And that's exactly what they're doing with commercial real estate and with private credit right now. They're lying about what the stuff is worth on their own books. They're selling it to your retirement, and we're not going to find out what it's really worth until the banks have gotten out of Dodge. And there's a reason for that. And there's a reason why the politicians are looking the other way right now. Bailing out banks is not very popular with the public. If we bail out Wall Street again like we did in 2008, the public will be up in arms. But who could possibly be against saving grandma's pension fund? If grandma's pension fund is going under and, oh my God, grandma's going to be left out in the cold, no politician will dare stand up and say, no, we shouldn't bail out these pension funds. And so what's going on right now, because the banks are being allowed to transfer this sludge into your retirements, is this is a bailout of the banks using your retirement as a conduit. Ultimately, they're going to park all this crap on your pension, then bail out your pension. And what's finally going to come out of it is going to be higher inflation, because they'll bail out your pension by printing money and further inflating the asset bubble. And so while you're being distracted by the orange herring, right, Herringus magatus, keep in mind your nest egg is being robbed by the financial system, and both parties are in on it.
Excellent. So I have a comment and kind of a question. So, what do we've noticed in the press probably 6 months ago, I believe they started talking about how, it was just the regionals, maybe it was a little bit longer, that were exposed to commercial real estate. And then we, kind of realized, oh no, of course, the big banks are exposed as well. In a way, the regionals kind of served as a distraction at first, right? These silly regionals that don't know what they're doing, they're clueless. But in reality, what I think that was a cover story for exactly what you're talking about. How can we, rehypothecate this risk out there? So what do you think? What do you think could be a potential trigger for these write-downs to start actually showing up in a way like on these balance sheets?
So the trigger in The Big Short, if we're going to use that as the example, was when the banks were finally securing a net short position for themselves, right? When the banks had sold their mortgage-backed securities and they had bought credit default swaps. So now it's in the bank's interest to allow these things to go down in value. All right. So that will be the trigger when, and we're already seeing that this is in progress, because, Bloomberg said the quiet part out loud, that risk is being transferred to investors, and investors as pension funds. So, the trigger will be when it's finally in the bank's interests to allow that price discovery. And we're obviously still not there yet. And in the meantime, we have things like small regional banks as they fail, like we had Republic First Bank failed a few weeks ago. They're being bailed out in full. The uninsured depositors are being bailed out in full at the expense of the deposit insurance fund. Again, the losses are being socialized. And so that's buying them time so that the panic in the regional banks doesn't expedite this collapse. It gives them more time to unload this garbage and the unsuspecting investors. So, I can't tell you when it's going to be. I can tell you they're already in progress doing this. And so I would just recommend to people, if you're in a pension fund or if you're a union employee, get with your shop stewards and start squawking about this, start making noise. Hey, the people who are responsible for our money that we've trusted, are they being good stewards of our money? Start making noise about this, because, they're distracting you over here with this trial. And meanwhile, your nest egg is being stolen from you. And I think people need to know that, and people need to pay attention to that.
One other point I'd make, just kind of going along with that narrative and what I experienced while all this was happening, because, I was right in the middle of it. And my company actually was the redheaded stepchild that was used often in the press for being, the bad actor, because we were the non-bank theoretically, although we became a bank later because we had a small bank, but that's another story for another day. But, we were the redheaded subprime lender. In reality, we had a huge government book as well. And the reason why we did our write-downs early was because Cerberus had purchased us at the top, and they wanted, and they realized it, and they wanted a purchase price adjustment. And so I would argue that in reality, the banks didn't get all the time they wanted, or we would have never seen Lehman. We would have never seen these things happen, Bear Stearns, et cetera. I would argue that there was an event like with my company where you just could no longer hide what was actually happening. And so that's kind of what I'm thinking about, on the lookout for, because I do believe we're going to get some kind of event here in the near future.
And Jack, I could just, I got a couple things for you. I want to reiterate some points that you made for the viewers, and then I want to direct questions to how people find out how their 401k is being spent. But just to reiterate, this is essentially, well, first of all, my feeling on what you just said is it's just the same old crap happening all over again. You have greed, corruption, fraud, the first to find the loopholes. And so we have all these loopholes again. And essentially what you're saying is okay, first of all, we have a CRE meltdown. We have a commercial property meltdown. We have vacancies. We have property values plummeting. And what you're saying is not only are teachers and firefighters paying for that bill, but there is an increase, a surge of 170%. So if there's any teachers and firefighters, and I know you're a volunteer firefighter, Jack, thank you. But also, how dare they? And so my question is this, Jack, and maybe you don't know this, and this is okay, but where do people go that have a 401k, you know, whether they're retired or not, where can they go to make sure that type of investment risk is not happening? And then follow-up question is, if someone has an existing 401k right now, especially if they're retired, Jack, where can they go to their 401k statement to find out whether or not their money is being spent on these toxic assets?
So let me preface by saying I don't have that piece of paper from the government that gives me legal permission to tell people what to do with their retirements. So anything I say, as always, folks, consult with a professional. That's my CYA take there. They're very good at hiding this stuff. You might hear a portfolio manager, a fund manager, or a financial advisor saying, no, we don't have any commercial real estate. Don't worry, we haven't put you in that. No, you're in safe, you're in ETFs and mutual funds. Well, sometimes they can hide that within the prospectus, within the prospectus, within the prospectus. And what I'm saying is, you know, the guy might tell you, don't worry, you don't have any commercial real estate, but you got to open up what you're actually in and look for phrases like income fund, right? And an income ETF or an income mutual fund. That usually means that they're parked in bonds and that they're out there chasing yield. They're looking for higher interest rates, and higher interest rates usually come with higher risk. And right now, commercial mortgage-backed securities is where you can get these higher interest rates. And over the years, a lot of these retirement funds have been kind of forced into this stuff because of the low interest rates, the ZIRP and BRRRR, the lower zero interest rate policy of the last decade. So a lot of funds were already in this stuff before this even started. But now, obviously, with the 170% increase, it's getting worse. You also want to look out for certain target date funds in the near futures. Like if you've got a target 2030 retirement fund, chances are, because that's so close in the future, you're probably in a heavier allocation of bonds, and you want to watch out for those. Within those funds, you're going to find a lot of these income ETFs and income mutual funds that are really targeted towards this kind of stuff. And of course, anything that says high yield in the name is almost certainly going to be buying this crap up as well. So, you know, they use words that sound really nice: income ETF, high yield, target retirement of 2030. And usually
but it's
those
nonsense.
are like the danger signs. Yeah.
And Jack, just for the sake of time, and I try to cut you short, I want to take a couple questions. We have our first guest here. Ulysses is here, so I want to get to him. But a couple good questions from the viewers. Here's one on the screen right here. You may not know this, but it states, will the state pension funds seek additional funds through taxpayers, through their workers, or both? Do you have an opinion there, Jack?
Yes, that's exactly what they're doing, right? They know they need to socialize the losses of these commercial buildings, right? The problem is so big. And of course, if we were to just bail it out right now, which I'm not proponent of any bailouts, but you know, to a hammer, everything looks like nails. And these Keynesians in the financial system, every time they screw up on a massive scale, socialize the losses is what they do. So their plan is going to be, first, move the debt from somewhere where you can't politically easily bail them out, the banks, move that to the pension funds, which is a very much protected class: teachers, firefighters, grandmas. Who could be opposed to bailing them out? You heathens, you know, you don't care about throwing grandma off the cliff. When it comes time to bail out pension funds, those things will sail right through the legislatures unopposed, because nobody would dare stand in front of that and say, don't bail it out. So the key is right now, while the risk is being put there, that is when the bailout is happening, even though they won't vote on it for many months. So absolutely, it'll sail right through those legislatures.
And last question, Jack, and then we'll move on to our next story here from Julius. Julius, I see you. Please stop calling me Ted Cruz. That hurts my feelings.
I'll bet.
But you started that whole thing, Jack.
I did.
It was a fair play. Are pension funds too big to fail? Why or why not?
I would say the pension funds are going to fail one way or another. All right. They're either going to have to default on some of their obligations, i.e., we made promises we can't afford, or they'll have to debase the currency and print money to bail out the pension funds, in which case, yeah, you'll get your dollars that you're owed, but those dollars are going to be worth a lot less than they were when they were promised to you. So one way or another, those pensions are going to fail, either by cutbacks to the payouts, or the payouts won't be worth spit when they finally happen. So,
all right, you guys. Well, that's a wrap. And big thank you to Jack for the story. Let us know how he did in the comment section. Share us your thoughts. And we're going to go ahead and move on to the next story now, which is going to be by Melody. And Melody has invited two guests. I have you guys. I'm going to bring the guests on, Ulysses and Kenny. And Melody's story is going to be on Case-Shiller. She'll explain what that is. She'll, go into what's going on with values. Is it useful? Is it not? But first, let me bring on Ulysses right here and Kenny. And Melody, please introduce your guests and take this sucker away.
Sure. So, Ulysses Awesome, you guys, Mr. Awesome on X Twitter. We also have Jordan Keckley here with us today, who goes by a different name on X Twitter. I'll let him talk about that if he wants to. But these are two of my colleagues that I talk to almost daily about employment, about construction, really about all of the macro news that we're getting out there. And so we kind of bounce ideas off of each other. And I wanted to bring them here because this week we got the Case-Shiller results and it's all-time high. And I don't know, Travis, if you're showing just for a visual, the slide to see, there just looks like there's no room for this thing to go any higher. And so that's confusing because there's a whole bunch of other series out there. So what we wanted to do in this show today is really dive in to what the Case-Shiller is, what it's meant to track. And the idea is exactly what you said, Travis, to, kind of help you guys come to a conclusion as to whether you think that this tool, which did not call the last housing crash in any way, shape, or fashion, whether this tool is really helpful for us right now. And so welcome, Ulysses and Jordan. Ulysses, if you want to kind of jump in, just if you want to say a little bit about who you are, what you do, and then kind of tell us about the history of this series, I think that would be great.
Yeah, you got it. Thanks for having me on, first of all. So I am a contractor and a consultant in the construction and real estate world. My background has spanned commercial real estate, but the last few years, production home building, including for what was previously a top 10 in volume home builder in the United States. So I've got to bring that perspective to my analysis that I've been sharing, both online and through Macro Edge Research, which is a publication that we've been sharing a lot of information about where the economy's at. So with the Case-Shiller, one of the things that it gets used for, right, to tell us that the market's doing well, home prices have never been higher. But the reality is the Case-Shiller index, and there's three different versions of them. It's a composite index, and it's a bit of a lagging indicator because it's taking only what are paired sales. So in other words, they have to go through records showing a home sold, has it sold in the past? And then they match those two, and they're comparing the time periods. So it's not exactly, an apples to apples comparison. And the other big portion that is problematic to me is how much it measures. In fact, if you were to take those paired sales based on how many houses have sold, we're generally only covering 20 to 30% of the market that's out there. So it's not even the majority of the market that we're really measuring. It's a small fraction at any given point.
Yeah, I think one of the things that really bothers me about it, Ulysses, is it's a 3-month moving average. Like we just got this series is for March. However, it's going to include sales from November, for example. And it could actually be further back. Like, Los Angeles during COVID had over a year delay in recording deeds, which would have meant that for a full year, Case-Shiller, who uses LA data, would not have had any idea about what was going on.
Correct.
And so I think that, that, and it's a 3-month moving average. And also a big thing that, Ulysses, I'd love for you to just spend a second talking about is the fact that, it's the moving average. It's an index. It's not absolute price levels. If you could just talk about that a bit.
Yeah, it's not price levels. In fact, the way that they break it out is they have multiple decades of category. So they'll index it from 1990 to 2000, 2000, 2010, and 2000 and beyond. And all they're really doing is saying in the year 2010, the price that they're measuring is 100% of the price. So anything above that, increase or decrease, will show up as a percentage, right? So if the index is at 150, it's at 150% of what it was in 2010. But again, we're talking about lagging data. It's a moving average, so it's not the absolute price level. It's the 3-month average, and that continuously gets adjusted every 3 months. So what you had in, say, January, now that we're into month 6, has also been changed because of the way that they're calculating that average. So it's the continuous 3 months, not just a quarterly 3-month average.
Wow. Yeah. So that really changes things. One thing that I've kind of noticed about it is, if you think about, I've been thinking about when would we start to see the seasonal decline in Case-Shiller, because something that I did, for my Substack and on X Twitter is looked at the 25-year kind of historical home price arc during the selling season throughout the year. And what you can definitely see is that there's a seasonal arc that happens, which is why maybe seasonal adjustments, someone thought they might make sense, but we can look at those things. We can look at that average and that history. And Travis, I don't know, I can bring up, it's one of those, it's a chart here. 1 second. Or maybe not.
I got your screen up.
Okay. So if you look at the lower left-hand corner here at this 25-year average home price arc for existing homes and new homes, you can definitely see that, we kind of peak up during the spring, summer season, and then kind of come back down. And so one thing that happened to me when I was going through a crisis in 8, 9, 10, 11, is every year we get super excited about, okay, home prices are turning around. But in reality, because people weren't looking at this seasonal arc, that's not what was happening. And really what I have come to understand about a lot of these seasonal adjustments is what happens throughout the year. What the news stories are about is just them correcting the mistake they made or the assumptions they made at the beginning of the year. And so, so we're basically looking at not real information and really more about adjustments to this model and to what they thought was going to happen. And so, and we will not see for the Case-Shiller, in my opinion, home prices start to come down until probably after the election, just because of the way it's built. But would you agree with that? Or
I would. Typically, any decline in that or slowdown, it's going to be lagging, and it's generally anywhere from 3 to 6 months. And given the spring being the sort of the peak season, it would be normal for most indexes to show that prices are increasing at the moment. So it's not necessarily looking at what's happening; it's looking at what was happening. And the other thing about it, their methodology that's problematic, is it's a composite of the American Community Survey, which is basically asking homeowners what they think their home value is, and then the 10 and 20 city composite index of the Case-Shiller. So it's really not measuring all of the same variables like you would sales or price. So it's bound to lag, regardless if it goes up or down. It's never projecting an accurate depiction of what's really happening in the market right now.
Yeah. And I think the other thing that an index does is it's trying to show you activity more than anything else. And I think that if we think about what was happening, at the beginning of the year, we had just had the December pivot by Powell, and every person out there that talked about housing, except for a few of us, was like dancing on tables. They were like, oh my gosh, home sales are going to go crazy. Zellman, they came out with one of the most aggressive forecasts. I couldn't even believe it. And so, I think when that happens, then sentiment changes, even if the facts on the ground haven't changed. And that creates, some demand. And we've seen a lot of that demand has been more in the top 10, top 20% for very expensive homes. And so I think that as rates kind of, did not go down as people expected, that this is when you're going to see that sentiment shift. But again, we won't see any of that coming into the Case-Shiller until likely around or right after the election. So
Agreed. I think if you look at the post GFC, wasn't it in 2010 when it actually started declining, the Case-Shiller index?
I am trying to remember the exact year. We could probably see it here on this series. It took time. It took a lot of time, and it didn't happen, during those peak years. And it took several years. I think we had a 5% decline, like you're saying, right around. I think that first part, like around 2009, but I'm not exactly sure. I can't see on this right now.
Sure.
So I can bring it. Yeah. But I wanted to kind of turn it over to Jordan. Jordan, you do a lot of digging into the bowels of data, be it from the BLS or whatever you can get your hands on, which I love. You were going to talk to us a little bit about Nashville when it comes to the Case-Shiller.
Yeah, so thanks for having me, everybody. Again, my name is Jordan Keckley. And I just sort of kind of stumbled into real estate. I'm to give you a bit of my background. I'm a healthcare guy, by day, and this whole real estate thing was kind of just a side hustle where I was just consulting for some small in-town developers. But I started my career out, I guess you could say, like, I'm a recovering CPA. So like, that's probably where all of these being into the weeds things sort of come from. But thankfully, that was probably like the first 5 years of my career. And thankfully I don't do that sort of work anymore because it is like, it's mind numbing. But, yeah, I mean, now, I'm more in the healthcare consulting, space. We're working with hospitals and health systems, and it's primarily on things like their strategic initiatives. And a lot of that is basically they're just trying to figure out the lay of the land in their market, what's private equity doing in the space, things like that. And in order to sort of put something meaningful like that together, you kind of have to get into these government databases or, other various data sets, and especially demographics. So that's, that's the real big connection, in my opinion, between healthcare and real estate and that whole space is really the demographic piece of this. So that's kind of where I come from in this equation. And I just started a Twitter account because I was just kind of annoyed at what I perceived as sort of all this misinformation out there. And I only know so much. I joined Twitter to learn too, and I've obviously met a bunch of smart people on X, I guess you could say. But yeah, like when it comes to, and again, I agree with everything Ulysses said. It's a flawed. I consider the Case-Shiller to be flawed. I mean, the fact that it's a valuated index, like we're talking real estate valuated index, and the value piece of that is based on the average sales price. That by design is going to be biased to the upside versus, say, like a median. That kind of drives me nuts. The thing that people need to think about when it comes to I just think of this in general. It doesn't matter what industry you're in, but when it comes to this stuff in particular, you need to be paying attention to the details. People just don't like to do that. Well, case in point, I'll talk about Nashville as an example, and specifically Davidson County. So we know that the Case-Shiller is focused on existing single-family sales only. It's a repeat sales index. Well, if I just look at something like the stock of homes in Davidson County, based on estimates, there's roughly 340,000 homes, total homes in Davidson County. Well, I mean, there's different types of homes. I mean, you could have, HPR detached or attached homes. It could be, multifamily. It could be duplexes. Heck, it can be even like mobile homes. So when I look at how that's changed over time, and I guess let me see if I can share my screen so you can.
Just a note on that while you're looking, the 20 city and 10 city indexes and the Case-Shiller, they only measure single family detached homes. So we're talking about if your house is a single family home with a yard and it's not connected, so it's no condos, no townhomes. So once again, it's even shrinking the footprint of what is actually measuring.
Exactly. Okay, so here we go. Can you guys see those two graphs? Okay, it looks like we can. So this is basically what I was just referring to. And the top graph is the actual level of homes in Davidson County. And then below that is just the share, just the distribution of homes. And when you look at that, what you're basically noticing, especially on the bottom graph, is that basically you just have a bunch of more multifamily in Davidson County. So is the Case-Shiller, first off, the 10 or the 20 city index is not going to pick up Nashville. It's just not in there. But we have now a smaller share of homes that would meet the qualifications to even be in the Case-Shiller. So there's all this nuance to it. And even when you look at this data at a much more granular level, like say by zip code, I mean, downtown Nashville, Melody, I mean, we just went on, the tour around town. I mean, downtown Nashville is just nothing but condos and apartments now.
Right.
I mean, that's what it is. So this is not representative, or the Case-Shiller would not, in theory, be representative under those circumstances, at least how it's currently structured. So I guess I can stop sharing. Let me see. There may be one other. Oh, crap.
So while you're doing that, Jordan, I think that is such a good point. It matters which cities are looking at. As people talk about often, real estate is local. Well, if that's the case, how can this series actually really represent what's happening across the country? And then to your point, you look deeper, and if you're only looking at single family home, like detached sales, those condos in some areas, condos are most of what transacts in a market. You think about Miami, for instance. So are we ever so we know the condo crisis in Miami is happening as we speak. And for those of you that don't know what that is, essentially a law was passed after Surfside, the collapse there, that people could no longer put off making repairs to these condos that were aged. And so what's happening is they have a deadline. They have to get these inspections, and then they have to assess their tenants, these condo tenants, with how much money it's going to take to get everything up to code. And you're seeing this all over social media. You're seeing it all over mainstream media, that people are having to move, having to leave because they can't afford these assessments. Well, how on earth, for anyone who's been to Miami And it's very similar to what kind of Jordan is saying about Nashville. So much of your housing stock is condos. How on earth could the Case-Shiller ever give you any indication of what's really happening in Miami? And it can't, is the answer. So that's why it's, you guys, you got some geeks on this show right now. We're all geeks and we like digging in, but this is why, because you take or accept something as fact, but when in reality you look deep into how it's being captured, it's questionable. It's meant to serve as kind of a, its own sort of product. It's not meant to tell you what's about to happen in the housing market. But Jordan, go ahead with what you were.
Yeah, no, I mean, absolutely. I couldn't agree more. And so, all I'm doing now is I'm just going to come at basically the same thing, but just from a different angle in terms of like, what properties are out there for sale. And this is Redfin data, real estate data. This now is showing the Nashville MSA, and it's the exact same information, top and bottom. The only difference is how it's cut. So as you can see on top, the bulk of homes, and I probably could have done a better job with my color scheme here, but the bulk of homes sit in Davidson County. That's why I wanted to talk about that, front and center, because I mean, population, the bulk of the population sits in Davidson County for the MSA. Obviously the homes are going to follow the population. But look, the same, you can look at that same information below. It's literally the same thing, but now it's cut by the type of property. And so when you look at that over time, well, look, there's more condos on the market, right? Well, then you could actually look at individual counties and you would see, for Davidson County, I'll just cut it real quick. See what that looks like. I mean, look how many more condos are now part of inventory. I mean, that's just basically since 2016, it's just been increasing, outside of COVID, obviously. But these are all sort of like the things that, at least when I'm looking at something like Case-Shiller, I'm just, it's going to be biased because of how it's designed. And I know there's even been questions about things like Redfin's index and their weekly data series and their monthly data series. And it's just, it's all so confusing, admittedly. So, but you have to pay attention to those details if you're going to make sense of it, in my opinion.
Totally agree. And thank you for bringing it back to Redfin, because they do something, they also look at county records, and that's often why their data is updating after. So you can catch it at a point in time and you can go back in a week and it's different. and this is why, it's so, in my opinion, it's so misleading. And to talk about an all-time high that's temporary, for instance, until, there's more data kind of put into the mix, it's just misleading. And like you say, it's very confusing, but I feel like all of these series could do a much better job at telling you what they actually capture. They're being weaponized as tools, especially during this election cycle, in my opinion. So, but Travis, we could probably take some questions now.
Well, I have a quick question. Maybe this is a test. Maybe it's not. Depends on your answer. So, a couple of points that you guys highlighted about Case-Shiller determining the direction of the housing market that I really appreciated, and I hope the viewers understand this, that it's a composite. They're not even looking at pricing values. That's insane. And also, they're only counting SFRs. Now, SFRs, single-family residences, or SFH, single-family homes, they are important. But there are some markets that have over 50% of condos and townhouses inventory. And so there is not an attention to detail when it comes to Case-Shiller. And so my question for you both is, and this is I know the answer, I have my own personal answer, but being that you're saying pay attention to the details, we know Case-Shiller is not details. And we know seasonality is a factor, regardless of we're in a crash cycle or not. Seasonality does play a role. what is the better method, in y'all's opinion, for the consumer to go to determine actual value and prices? What method can people use to determine that accurately?
Yeah, well, I think, doing some research on the market that you're looking into and what actual sales have been is always going to be the best method. You want to know exactly what's gone on. Pay attention to the trends and look at a longer time frame. I think one thing that we've all experienced over the last 4 years is an enormous distortion in transaction activity, right? And from an explosion of sales to now sales are basically lowest level we've had back at COVID lows. So you want to be making sure that you're looking through that whole cycle where prices have been, so that you're able to make your own decision on valuation. That would be my recommendation if I was to give one. I would never use the Case-Shiller in doing a market analysis or discussing, basic potential price points for the developers that I consult with, because it's not data that I can say, here's hard facts, hard sales in the market.
Yeah, I think that's spot on, man. The hard sales, for the viewers, that's a sale. We refer to that as a comp, a comparable sale. And really, you want to go hyper local. You want to go to the neighborhood. You want to go to the subdivision. And what I do as a realtor is I go back to 2020 and I look at all those cycles. I look at the run-ups. That's kind of how I gauge whether or not it's a good or great deal. So thank you. I'm done with my questions. Jack?
So my question really for anybody on the panel here, we've seen a couple of trends over the last year or so. The lower pricing levels have pretty much been frozen in place, right? We have entire generations, the Zoomers and the Millennials, have been frozen out of the housing market because of the high payments and the stagnant wage growth. And so we've seen a lot of stats like median home prices going up because more of the deals are happening in the higher end of the home price spectrum, because those are the only people who can afford. Maybe interest rates aren't so important up there because you have more cash buyers at the higher end of the spectrum buying more of the top tier homes. So would that trend, could that be sending false signals via Case-Shiller to make it look like the average home price is rising when really all it is just more deals happening with more expensive homes while fewer are happening with the less?
So, yeah, I mean, I'll try and address that. I mean, I think just if you're thinking of like mean and median, in this environment, when you have something that is designed to evaluate a market and it's based on the average value of a home times the number of units within a given area, and that's how you're coming up with a value weight, that by design is actually going to push it higher, especially in an inflationary backdrop that we find ourselves in. So, I mean, even things like mean versus median are important, but are most people looking at those things? Not necessarily. And yes, just in general, the market, our economy is just, people say this all the time, but like when you get into the weeds of all of these different economic data series, at least in my opinion, it is extremely bifurcated, period. There are people doing really well, and then there's people who aren't doing really well. And those are like the blue collar folks primarily. It's also just younger people. If you think about younger people as an example, the home ownership rate for them is like 40%, which means the remaining 60% are renters. The unemployment rate for that cohort is actually higher than just the headline U3 number that you see. And so, yeah, I mean, you do have this scenario where it really is like the haves and the have-nots. So that's what I'm seeing, at least in the data.
Okay, you guys, just for the sake of time, if you guys don't mind, I have one question from the viewers. I think this is a great question. It may not fit into this segment well, but it is great. And either one of you can answer. Just jump in or raise your hand and I'll call on you like the good teacher that I try to be. Does anyone else think that the dollar bouncing around destroys the global economy first and then it hits America? What are you guys' thoughts on that? Yeah, Ulysses.
Yeah, I think we are obviously going to be the last one to get hit. Parts of Europe are already in recession. Part of Japan seems to be in recession now. GDP is going negative. They're having their own dollar crisis. It's typically how recessions have worked, and I think we're close to one. If not in one already, and we know that they get backdated, but part of the issues we've had with the dollar and devaluation, or however you want to look at it, volatility. I don't look at it the same way a lot of other people do, comparing to other currencies. Look at the housing market, actually, is what I use as a gauge. And when we have prices going up rampantly, people are valuing their dollars less than they were prior. And now that we're sort of hitting the bottom in sales, it's kind of the opposite. Now everyone goes, okay, well, I need my dollars. So when people start really caring about that, then yeah, we're kind of at a bottom point or recession, right? We don't have access to credit, and people care more about their dollars. So yeah, take that how you want, but I definitely think that's recessionary.
And Kenny, do you want to add anything to that?
Yeah, I mean, I just keep it like Ulysses said, just with the housing market. At this point, it's just an inflation hedge. I mean, yeah, we're going to continue to devalue our currency. I'm no Forex expert by any stretch of the imagination, but I mean, that's what's happening. I mean, it's basically turned into this speculative investment vehicle or an inflation hedge. And yeah, that's where we're at. It's unfortunate. So,
and before we let you guys go, and starting with you, Kenny, can you tell the viewers where they can find your information?
Oh, sure. Yeah. Over on Twitter at KennyCap PhD is where you can find me behind the mullet.
Behind the mullet. And Ulysses, where can they find you?
Yeah, so you can find my writings and research regularly at macroedge.net. And you can also reach out via at Mr. Awesome on Twitter and get a hold of me that way as well.
Okay. All right. Melody, do you want to say anything else before we let him go?
Just want to thank you guys for coming on today, sharing your expertise. I understand, guys, as a data geek myself, this stuff can seem pretty boring and hard to understand, but the overarching message is that the details do matter, and we should all be diving in more when these things are being weaponized for a specific narrative, especially in an election cycle. But thank you guys for coming on.
Thank you all very much. It was a pleasure.
Thank you.
Thank you, guys. All right, that's a wrap. Now, the next story that we are going to move on to is going to be introduced by myself. And this story, you guys, is going to be the history of the housing market crashes and elections. I'm actually going to go back all the way to the 1980s, and we're really going to dig in to find out how many times exactly have home prices went down. Now, I've played many clips, probably 100 times by now, of Dave Ramsey going on record saying that there's only been one time in history where home prices went down on a national level. You guys, there's actually been 5 times on a national level where home prices went down. So we're going to look at that, and we're going to look at the elections, and we're going to ask this question. So in my segment, we're asking the question, why do people, or rather, why do the bears, I'm a bear, I'm a koala bear though, so I'm gentle. Why do bears say the housing market is going to crash after election? Why are we saying that? And what I hope that the viewers are going to gain is an answer to that question. And I hope that the viewers will identify through their own research and mine that there are 5 different crashes. And how do the elections actually play a role in keeping values propped up? What's leading to these crashes? And so, you guys, that's where I'm going to start today. Let me go ahead and throw up my screen right here. So what we're going to do, guys, is first we're going to identify when the housing market actually crashed, because it is a fairly rare phenomenon. And the way we're going to do that is we're going to review this article right here. This is New Silver. Now, the title is when did the U.S. housing market crash? 2 bullet points I kind of want to go over real quick. Number 1, the U.S. housing. First of all, you guys, this article is basically stating that there are 2 things that stand out above the rest of the factors when comparing the housing market crashes. The number one thing is the US housing bubble popped. So a bubble had to form before it popped. Now, a housing bubble occurs when there's a rapid increase in the market value of housing, kind of like what we had recently, followed by an even faster decrease in value. That's what we're waiting on, which is what is referred to as a crash or busting. Simply put, house prices in the US were widely overinflated. Market sentiment was overly optimistic, and a market correction was bound to occur. It was bound to occur. Bullet point number 2, commonalities, okay? Borrowers, and here's the thing, you guys, I hear foreclosure crisis, subprime loans. The reality is the good people credit loans stop paying their mortgages as well. In fact, more people with great credit stop paying than the people with the bad credit. Borrowers, bullet point 2, borrowers couldn't pay their loans back. This is called the subprime mortgage crisis. But again, I call that an affordability crisis. Melody, would you agree with that? Do you think that it was more only the subprime borrowers stop making their payment? I mean, you went through this, or was it also the prime borrowers?
No, the majority were the prime borrowers. The non-prime were the non-traditional products, the investors, plus because in reality, even our non-traditional products lending that we did, and we were considered a non-prime, subprime lender, were actually of great credit quality. So if we did a stated income loan or an Alt-A, the credit score would have to be very high for that to get through. And so in reality, subprime was, again, smoke, but it's the smoke they used to distract everyone with what was actually happening. And it, who ultimately got wrecked were those prime borrowers.
Travis, if I could weigh in real quick there, I don't think it's so much important as to when subprime stops paying to the formation of the bubble or the bursting of the bubble. I think it's when they start marketing to subprime, that's when the bubble is almost exhausted, right? If you're blowing a bubble with bubble gun, you have to blow the hardest to get that last little bit of inflation, right? So
I mean, it's hard, Jack, because I was in the business starting in 2002, and to me, the fraud was there the whole time. So it's hard.
It really started pushing. It got really ridiculous at the very end, right? That's when they really start pumping it out, when they're looking to expand the population of buyers because there's no one less to buy.
I will say that towards the end of the subprime collapse, as they say, they did make a huge push for the neg-am loans, those negatively amortized loans where it had a minimum payment that didn't even cover the interest. So there was a push, you're right, at the end to kind of squeeze the remaining juice out for sure. But I wanted to read this because this is contrary to what we just said. Importantly, the U.S. housing market was overloaded with subprime mortgages. But again, they're saying the borrowers couldn't pay, and that's the real issue. It wasn't necessarily the subprime mortgages, although that was a contributor, okay? But this goes on. The borrowers started to default on loans, and it goes on. They should have never been issued in the first place. But like Melody and I are trying to say, that hit conventional products, prime good credit loans as well. And this is what I want to point out, you guys, okay? Look at the housing market crashes. Here's a timeline of major housing crashes in the US. Again, this is contrary to what David Ramsey says. And I want to make a point as well. This is only showing 4. I told you guys before we started, we actually had 5. And I know some of people wanted a definition of a crash. They're defining a crash as basically prices going down. They are not including the housing market crash of 1990. 1990 also had prices go down, but this is referring to the 4 crashes that happened in 1837, 1873, 1929, and 2008. And again, you guys, in a minute here, I'm going to put an overlay of the election cycle as well. But what I wanted to point out is we did have a housing market crash. Values of homes did go down. Now, the first one was the Panic of 1837. I think it's very interesting because there's some common themes here that pretty much all crashes have. And I think that we're experiencing the same thing right now. Now, the 100 years between 1800 and 1900 were trademarked by several peaks and busts in the real estate market, reminiscent of the markets today. And again, this is, although it's rare, it's kind of a healthy thing. The most prominent early example took place in 1837 when the stock market peaked and launched a depression that would last until the 1840s. So what I really want you guys to pick up is that it takes time. And this was a huge, the stock market was a huge contributor to what was happening in 1837. Now, the next housing market crash, something similar happened in 1873, stock market crisis. The 1873 stock market crisis, or panic of 1873, originated in the US, but had global repercussions, triggering widespread economic downturn and financial instability. Right now, like the report that Jack just did, I mean, Melody we have issues in Germany, Japan, China. The globe is getting hit. We have a little bit of a globalization process going on. But this is the second paragraph, and this is very interesting. A full-scale bank collapse contributed to the economic turmoil of the time, with severely established banks falling to their knees. So far, what we have here is an overvalued stock market that crashes, and we have banks going under. The third housing market crash is the Great Depression of 1929 to 1939. Again, you guys, we've had multiple eras of price crashes in the housing market, although it is rare. The most notable crash, Dave Ramsey, someone give this to Dave Ramsey, is of the 1990s, took place in 1929 with the crash of Wall Street. Again, the stock market. Isn't the stock market overvalued right now, Jack? Can you confirm that or not?
Oh, that's just one of those crazy conspiracy theories there, Travis, that we have overvalued stock markets with companies trading at 40 times sales. You know, take them 40 years to earn back what you're paying for the stock. That's just a conspiracy theory. I don't know.
Okay, well, enough of your conspiracy theories. This article goes on. As a result of the crash of the 1990s, prices fell. Sit down. Dave Ramsey missed this, you guys. 67%. House prices fell 67%, with properties plummeting in value and bank lending decreasing as well. It happens. It happens, you guys. This is nothing new. There's literally nothing new about what's going on right now. Now, again, this is skipping 1990s. It goes on to the 2008 housing bubble. And I'm just going to read this thing down here for you guys, and then we're going to go into the election timelines. In 2007, real estate crashed completely, with hundreds of thousands of homes going into foreclosure, multiple subprime lenders declaring bankruptcy, and the market requiring government bailout. What's interesting, guys, is right now we've already got the government bailout. It's called inflation. So, which means any additional bailouts at this point, because we're battling inflation, will make things worse for us. So it's really important that we, and I'm not going to go into politics here, but that we elect people that are not just going to spend money that we have to pay. And the reality is all of this taxes, all of these fees, it's being put into the values of our houses. The real people that are paying the inflation and all of this reckless spending are the new homeowners 100%. It's insane, absolutely shocking to me. That's where the value is. That's why the stock market, the economy is still kind of trucking along. We don't have the the decline in value yet. Now, here's the thing, guys. Let's go to the election dates. Okay, so here's all of the dates of the election, and I'm going to point out a few things. I'm basically going to show you guys what happens during the election cycles as it pertains to the housing market crashes. So the first housing market crash was I wrote this down here, it was 1837. Okay, so the first housing market crash was in 1837, and you'll notice, and you guys are about to see a trend here, and it's really shocking. This is why bears say after election, the housing market will crash. The first housing market crash in our history happened 1 year after election. Okay, 1 year after election. The second housing market crash happened in 1873. There was elections in 1872. The second housing market crash in America happened 1 year after election. Okay. The third housing market crash happened 1929. All right. We had in a presidential election, you guys know when? 1928. 1 year after election, we had a housing market crash. The only time that is not true is the most recent housing market crash of 2008. In essence, in 2008, that was the presidential election, and that was essentially the start of the housing market crash. You can kind of look into 2007, but my point here, y'all, is according to this article, 75% of the known reported on this article, okay, so on this article, 75% of the housing market crashes happened 1 year after presidential election. So I would say this is somewhat founded, but there's more, you guys. I want to show you something else. Okay, what happens to the housing market in an election year? I want to read these 3 bullet points, and I want to show you what the housing market does the year of election. Now, first of all, the first 3 bullet points is, despite the common belief that elections negatively impact the housing market, data does not prove out this theory. So according to this article, elections do not negatively impact the housing market. It's the year after the election. Bullet point number 2, the housing market is influenced by a variety of factors, including supply and interest rates, and have a greater impact than the presidential election. I would definitely agree with that. Supply is important, despite the bulls no longer thinking it is. Bullet point number 3, for most Americans, election results will have little direct effect on their income and therefore should not significantly impact their decision to buy and sell a house. Okay, fine. But let me show you guys this, okay? So I'm going to scroll down here, and what I have done, and let me try to zoom in here, is I've highlighted for you the election years. Okay, first of all, is I've highlighted in yellow the election year. To the right of the year that's highlighted in yellow is home price appreciation. And what I'm going to point out here is how almost every single election year, home prices go up. Because the president or whoever wants to become president or stay president continues to prop up the economy, because usually people vote on the president based on how they're doing financially. Okay? And I'm pointing that out again because that's what's going on right now. They're propping up the housing market so they can try an easier path to election. That's my opinion. But look at you guys. If we go back to 1988, look at the previous year. Okay. First of all, 1988 had a 7.23% increase in value. Let's go to 1992. So we go to 1992, the election year had a 0.82% increase in value. If you look at the last, previous 2 years, there was decreases. So again, going into the election year, home values started accelerating. When we go into the 1996 presidential election, again, same thing. Home values went up 2.43%. The previous year was 1.79. Previous to that, 2.52, 2.16. Now, when we get into the years of 2000, we can definitely see the difference. The year of 2000, home values went up during election year almost double digits to 9.29. If you guys look at the last 4 years preceding the election, you'll see that this is the highest amount of equity increase. Now, again, they're getting good at this, because the politicians now understand that our whole livelihood is kind of wrapped up in our homes. It's a really sad thing. And look at 2004. You can really see this in 2004. They went crazy. 2004, home values went up 13.6%. The previous years, 9.8, 9.5, 6.6. Home values went up the most during the election year. But again, you guys, that did change in 2008, which again was an election year. We actually lost 12% in value, which is absolutely crazy. But then we go back to on track. Look at 2010. 2010, home values went up. I'm sorry, 2012. I apologize, guys. 2012, home values went up 6.4% during an election year. Look at the previous 3 years before election. Home values went down all 3 years, because again, they understand how important homes are to people. Homes are to voters. We fast forward to 2016. Same thing, you guys. 2016, 5.3% come up. Look at the previous year, 5.2. Previous before that, 4.5. Then we go to 2020. Same thing in 2020. 2020, 10.43% equity increase during election. Previous year was 3.6. So it went up 3 times the amount roughly during the election year. Now, again, here's the thing. Okay. Sorry about that. Here's the thing that I'm really trying to highlight here. Elections do matter. And the reason that they matter is because it appears, again, we looked at the data, it appears that the powers that be are just propping things up. And my warning to people is that the more that the government and politicians, the deficit spending, the Federal Reserve, the more and more they continue to prop up the housing markets based on the backs, especially of new homeowners, of homeowners that are on fixed income, the more pain that is going to come, the bigger the bill will be. We need a natural course of a reset. And guys, in conclusion, you guys, here's where I want to conclude. If we look at historically, if we look at the 4 housing market crashes, they didn't want to count 1990. Housing market crashes happen 1 year after election, 75% of the time, based on historical data. And that's the information that I want to give to the viewers today. What do you guys think about that?
So Travis, something I just also though, like we can look at that year and look back at price levels then, but in 2008 during that season, prices did increase. And so, although over that year they went down, while people were campaigning, they were increasing. And so that happened even in 2008. So I think absolutely, it matters. And I think, my question for you on that data is just kind of, did it change sort of how you're thinking about, I mean, this, I think, just what we might see this year? Or how do you think this might play out?
It did change my perspective, Melody, because it strengthened it. I already saw the deficit spending. I knew that greedy people want to stay in power. I knew that dishonest people would continue to lie to stay in power. I knew all of that. What I found surprising is I was able to track down, with that article's help, two additional housing market crashes, which was in the 1980s. And I found it very intriguing that 75%, 3 of the 4 of those housing market crashes actually happened 1 year after the campaigning. So again, by me digging deeply, it further reinforces what we're saying, that the country is being ran by a bunch of liars.
Travis, I have a question for you. I didn't live through 1929, obviously, but it's recent enough, and I had distant relatives that lived through it that I was able to interact with over the years. We know how severe 29 was. We know how severe 2008 was. I'm not too familiar with the 1837 and 1873 panics. And notably, we didn't have a central bank back then to go Zerpenburg to try to rescue us from those panics. Now, have you done any research, or do you know anything about how severe those housing market crashes were? How long did they last? Were the dips any bigger than the 2 more recent ones? Because I wonder, were we better off when we didn't have a central bank to come help when the market crashed?
Well, I'm just going to say, hell yeah, we were, because by the Fed being involved, they continue to devalue money, and we have to pay for that, and they save the banks at our expense. So despite what I'm about to read, I would say, well, I got to be careful. I don't want to get a shit down. But as far as 1837, I mean, 1837's lasted until, that recession lasted into the, 1840s. So it was that's kind of a long recession. And also, Jack, 1873, it's hard to get information on the 1800s. It
Obviously,
doesn't give
data wasn't so good back then.
What one thing I would say, guys, though, because I have done some research into these historical periods, is that it might not have been the Fed, but typically what you would find as the reason that you got yourself into this trouble was that there was some form of easy money, whatever it was at the time. But and that is ultimately what happened, is that, you had that credit loosening. Now, not as sort of, not as established as like the Fed, but it would be some type of government intervention that was some sort of easy money policy that then would lead to these bubbles as well. So not the Fed, but similar type of monetary policy.
That was another thing. So we had that stock market euphoria kind of busting, but then pretty much every single scenario was also a financial crisis. So it's kind of like, so I asked myself, Melody, Jack, do you guys think that the financial crisis this time, well, I'll say consumers not paying their debt because we see that trajectory, but what about CRE? I mean, you just did a story on that, Jack. I mean, can't commercial real estate meltdown be the next financial crisis?
I mean, it already is, right? We're extending pretend. We're just pretending it's not happening. And by we, I mean the banks. And that the inevitable pain from that collapse is being slowly put on our backs while we're being reassured constantly by the establishment financial press that everything is okay. And then when we point out, hey, everything's not okay, we're called doomers. It's one of the reasons why we started this network, right? But yeah, absolutely. I mean, take your pick for today's market. What do you want? You got record consumer debt. You've got record housing prices. You've got record stock prices. You've got commercial real estate. You've got a collapse going on in Japan of their currency. You've got a real estate collapse going on in China. Oh yeah, World War III. So pick your poison as far as the triggers. I don't know that we've had as many different things all going on at once, any one of which could cause an event like this, or maybe one triggers all of them, like dominoes.
Well, let's take this question right here. This is Jungle Book. Shout out to you, brother. Cool dog. He's in our Discord group. We try to have a little bit of a family there. He has a question, and I'd like you guys to answer this, starting with Melody. How does today's market compare to other crashes? How much of a crash do you think? Now, I mean, we're guessing. It's impossible to guess fully accurately. What do you think we're going to see this time around, Melody, and how does it compare from your opinion?
Yeah, I mean, I don't have the numbers in front of me to give you the absolute percentages, but what I would say is that, I think we are going to see a similar kind of reversion back. We're going to probably see around a 30% overall decline, if not a little more, but it will take a long time, as you kind of illustrated, Travis. These things, housing is like the Titanic. It takes a lot longer to turn it than to sink it. And so, it just takes time for these things to play out. But I think likely what will occur, if there's not an exogenous event, is we'll see kind of a 5% decline on aggregate at the end of this year. And then a much steeper decline of between what we saw, probably that 12% that you were talking about in 2008, Travis, like between a 12, 15% in 2025, with a few more years of just kind of, price declines, not as stark, but similar to 2008, where you bottomed out from home price depreciation in 2012.
Yeah, I mean, arguably, actually, five years if you count 2007. And Jack, will you add on any comparisons? And I have another really good question. Charles Wang.
So maybe not so much a comparison as I would say, with each crash that we've seen, at least in my lifetime, the size of the government's intervention and response has been growing exponentially. Yeah. And it's easy money, and lowering interest rates to fight recessions is very much like a narcotics addiction. The longer you do it and the more you do it, the bigger the fix has to be to achieve the same effect. And easy money is every bit a financial narcotic. So with the next crash, it's hard to handicap how big of a crash, because that depends on how big of an intervention. And so in my opinion, it's not so much like what percent will homes go down, what percent will stocks go down. It's going to be how much do they lower rates and how much money do they print? And then how bad will the next iteration of inflation be after that? And we've seen it gets worse and worse each time. And we are getting to the point where now debt to GDP is so big that by the time the next hike cycle comes around, when it's time to fight inflation again, the debt will be so big they won't be able to raise those interest rates because the government will become insolvent. And that's what Japan is dealing with right now. And that's why the yen is collapsing against the dollar, because Japan has 260% debt to GDP. They need to raise rates to stop the collapse of their currency, but they can't, because they'll be instantly insolvent if they do that.
Germany, China, I mean, it's just happening around the world. This is nothing new. It's just the bulls are incentivized to continue to sell you on spending money. In fact, their jobs, listen to me, guys, their livelihood and jobs depends on you continuing to buy no matter the danger. I want you guys to remember that. I have another really good comment right here. This is from Charles. Thanks for your support, Charles. I see you on my own channel. I love you, brother. I just appreciate your engagement. He's got a really good thing. I mean, this is a good point. Either you have to be poor to get government support, or super rich. The middle class, will say, is kind of screwed. What do you think about that, Melody?
Well, this is why I often talk about the forgotten American. I took that name from a book by Amity Shlaes called The Forgotten Man, which is about the Depression. And it's about how, they did all kinds of crazy policies back then to try to get the economy back on track. Sound familiar? Some crazy tariffs sound familiar. They were doing everything they could, but typically what would keep happening is it was always the folks in the middle, the hardworking people who were just trying to pay their taxes, went to work every single day, that just completely got screwed every single time. And so I absolutely believe that all of this is being carried on the back of that forgotten American who is paying their taxes and getting up and going to work every day, sometimes at 2, 3, 4 jobs.
Jack? Good
Yeah,
answer.
I would say the destruction of the middle class is, the people that are doing it better be careful, because as the wealthy have been getting wealthier and wealthier and wealthier, it's been at the expense of the middle class. Most of the middle class has been pushed below the poverty line or down near the poverty line. A few lucky few, like probably most of us here on this channel and most of the people watching are probably lucky enough that they've escaped into the upper middle class. But that's very few. Most people have been pushed down and are now seeing big declines in their standard of living. And when you run out of a middle class to squeeze, that's when the garden tools come out. And the people at the top need to be very careful in that scenario. They're playing with fire with what they're doing. And I think they're going to regret it someday. I really do.
I'm gonna say, in my opinion, Charles, that here's the bigger crisis that literally no one is talking about. It's the American family. Those are the people that are getting screwed. The husbands, wives, children. The inflation is affecting their livelihoods, their ability to learn, the chiseling down of the family and the unity of a husband, wife, children. That's the crisis here. The more that's chiseled down, the less protection that we have as consumers. It's a horrible, horrible thing, but I do have a little bit of time, so I'm going to do one more question. Okay, don't be mad. I left myself a little bit of time. This is the last one. Okay, this is an interesting comment from KPal. I love that profile. I love the profile picture, KPal. It kind of makes you wonder if we're in a transitory. This is good. Transitory stagflation period, followed by deflation. That's an interesting comment. What do you think, Melody?
So it's really, really hard to make this call right now because of that government intervention and the form it's going to take. But I think if forces were left to their own, that we would start to see deflation. Because we're really already starting to see it. And many will argue that we never had monetary inflation, but we can all say we've had higher prices, and so it could be that we are in this transitory kind of stagflation period. I think long term, my thesis for exactly what Jack was just saying is that this is different from the the hyperinflation folks. I think that if we start seeing increases in inflation from where we are today, and I mean by prices, that the pitchforks will start to come out. People will not be able, that's when you'll have social unrest. And so I do think that we're going to see deflation.
Jack? You're muted again. Jack loves muting himself, Melody. He's so polite. He's just so polite.
Shut up.
All right. Go ahead.
So right now we don't have stagflation, right? I'm not sure the textbook definition, but it's something like economic contraction, typically including higher unemployment with simultaneous price increases in inflation, right? That's stagflation. We don't have that right now. But what we do have, I would say, I'm getting a little semantic here. We are stagflationary right now. We have unemployment is rising. Economic growth is slowing. So we're heading towards part of that stagflation environment. And at the same time, inflation is still sticky high. And we're seeing things like commodity prices are starting to run pretty heavy here, right? Gold near all-time highs, silver's going up. So we are seeing early signs of potentially a second wave of inflation that may eventually appear. So I'd say we're trending in a stagflationary direction, but we're not there yet. And to Melody's point, that government intervention that we all know is coming, that's such a huge variable that we can't see what it is yet. It's hard to make a call about what's going to come out the other side until we get some quantities there on what they're going to do.
And just quickly, I'll say though, we can say that we're not there yet because, some people like Danielle DiMartino Booth think we're already in recession, and that when they restate these numbers, restate GDP, things of that we might already be at those sort of contraction levels. And so it could be that, because I agree with you, Jack, by the definition, we're not, but we're definitely in that kind of, like, what did you call it again?
Stagflationary?
Yes, exactly.
We're trending there.
Exactly. Yep.
All right, guys, I just want to end by, to the viewers, you're on the sideline, just be patient. I mean, we just showed you data. Things take 5 years, 10 years, whatever. But if you don't want to have patience, if you still want to buy it because you think you're in a great situation, for the love of God, please use fundamentals like wedge, cash flow, and doing your homework. Don't just blindly purchase real estate, please. And don't trust the people that are working for you. Never trust. You could trust them, but verify. Plan ahead to get ahead. And that's a wrap. So we're going to move on to our next story from Jack. And Jack's actually going to cover the cover. I can't even talk right now. I'm so excited to not be like center of attention. Just kidding. I love being the center of attention. Look at Melody knows. Jack's going to cover the buy now, pay later financial disaster. Jack, it's all yours, man.
Yeah. All right. So what we're looking at here, I love this meme. All right. And anybody, let me know in the comments. Have any of you guys become increasingly frustrated with CAPTCHA recently with these stupid things like trying to prove you're not a robot is getting harder and harder? And like, do you click on that top little corner there? Is there technically traffic light in that square?
Yes, it is.
Oh, it never works.
Or is it?
So
Right. Yeah.
All right.
Agreed.
Well, we have one guy to thank for that. This guy, Max Levchin. All right. He's the inventor of CAPTCHA. All right. He's also one of the early founders of PayPal. He's the one who gave us that stupid pick all the school buses and traffic lights thing. And he's also at the forefront of the buy now, pay later scheme. He is the CEO and founder of Affirm, which is one of the biggest buy now, pay later companies that's out there. And I think buy now, pay later is just a whole new iteration of subprime. And I think it's one of these things that has economists scratching their heads right now saying, how has consumer and retail spending been so strong when we have all these indicators, higher interest rates, stagnant wages that say it shouldn't be? And I think this guy is the reason why. And I'm picking on Max a little bit here because he's the figurehead for buy now, pay later. But there's other companies, right? Apple is doing buy now, pay later. Klarna, Afterpay, right? There's other players here, Block. But he's the big player here over at Affirm. So let's talk a little bit about some of the data that we've gotten just in the last week here. A few stories, right? We've got GDP shows U.S. economy grew at 1.3% in the first quarter as consumer spending slowed. We had a new GDP was the second GDP estimate for the first quarter came out this week, and they dropped economic growth from 1.6% down to 1.3%. All right, there's your slowing economic growth that we just talked about in the stagflation question in the last segment here. All right. And this reduction in GDP, which was a pretty significant reduction, when they lower between first and second estimates by 0.3%, that was a pretty big surprise. And they're saying here in this article, it was almost exclusively driven by slowing growth in consumer spending. The revised report showed that consumer spending, the main driver of the economy, grew at a 2% pace instead of a 2.5% pace, as previously indicated. Household spending had risen at a rate of more than 3% in the prior 2 quarters. So we're seeing a deceleration in consumer spending. It's just starting, and it's already starting to hit GDP estimates in a pretty big way here. And we got some more data in the last couple of weeks, like this one, also in Market Watch on May 15th. Retail sales were flat in April, falling below economists' expectations. All right, they're saying here the retail sales were unchanged in April, the Commerce Department said, as sales at gas stations offset weaknesses in cars and several other categories. So really, higher gas prices were kind of hiding that we actually had a slowdown in retail sales in April. They're saying people spent more money at gas stations because gas prices went up. So the consumer is slowing here. He's starting to slow down. We also see it in this chart here. This is consumer credit card debt. All right, America's credit card bill. And this chart, it just makes me sick. I cringe every time I look at this. Look at what we've done since 2021 with all the stimmies, and look at how we just ran up the credit cards. As soon as the stimmies stopped flowing, we just started putting everything on plastic. And we also invented this buy now, pay later phenomenon while we were doing that. But you'll notice what happened at the end of March. At the end of March, the credit card bill stopped going up. The banks are starting to tighten their lending restrictions on credit cards. Credit cards are maxed out. People aren't getting new increases in their credit card limits, and delinquencies are starting to rise. And really, since the end of March, early April, this has actually been trending down. So the people aren't putting as much on the credit card anymore. And you can kind of see here, while all this is going on, delinquencies are starting to rise here. This most recent data point is the first quarter. Look at credit card delinquencies in blue. They are rising big time, almost as fast as they did in the lead up to the GFC. We've also got auto loan delinquencies are rising quickly. Mortgages defaults are taking their time. They're rising, but very slowly. And of course, this red line, the student loan debt, that's fake because the government made it illegal to report delinquencies on student loans. So that number would actually be like through the floor, through the ceiling of my house, and a threat to aviation for any planes flying over my house if they were going to tell the truth about that. So the point is delinquencies are rising. Delinquencies are rising in every category, faster in some, but they're on the rise. And then we got this a few months ago. This was back in February. All right. Our boy Max over at Affirm, they reported their quarters and they said something interesting. You know, they're talking about here, oh, if you're shopping at 2 a.m., that's a red flag for a buy now, pay later lender. They might not approve you if you're shopping at 2 a.m. He's trying to make it look like Affirm is this edgy new thing where they're analyzing your data and they're using that to gauge your credit risk. And he's claiming that they've been so successful, and there's no way to verify this because buy now, pay later debt is not reported to credit agencies. That's huge and so important. There is no transparency whatsoever with what they're doing with this debt. And what Max Levchin was saying, they're saying here last week, this was back in February, Affirm reported that 30-day delinquencies on monthly loans held steady from a year earlier at 2.4%. Even as total purchase volume surged 32% during that time. All right, so Affirm is claiming some very impressively low delinquency ratings on this buy now, pay later debt. 2.4%. All right, and again, look at what credit card delinquency is doing. It's up over 70 now, and that's 90-day delinquencies. And they were saying that 30-day was only 2% and change. Suspicious to say the least. Now let's look a little bit closer. Who uses buy now, pay later? This is in the Wall Street Journal back in March. Younger Americans with more debt and lower credit scores. All right. Remember, Affirm is telling us that they've got a 2.4% 30-day delinquency rate, even though it's young Americans with more debt and low credit scores that are predominantly taking out this buy now, pay later debt. And this line in particular in this article really jumped out at me. BNPL users had riskier credit backgrounds than other borrowers. Buy now, pay later users had an average credit score between 580 and 669. Average. Half of them are lower than that. That is subprime, right? The average credit user has a subprime credit rating for buy now, pay laters. And they're saying this is considered subprime. Consumers with top-notch scores were less likely than those with deep subprime scores of below 580 to borrow from BNPL. So what the Wall Street Journal here is saying is these are the riskiest borrowers in the world, or in America, we'll say, 580 to 660 on average that are buying buy now, pay later at a time when delinquencies in virtually every category are going up. And yet our boy Max here, Max Levchin, is claiming that they've only got a 2.4% 30-day delinquency rate. So that either this algorithm that analyzes your shopping patterns based on what data, I don't know, either that algorithm is amazing or they're just flat out lying here. So this information doesn't really add up. And we've had some data points in recent months that suggests my suspicions might be correct. In this article in Bloomberg, they're saying what's buy now, pay later, how it works, and the hidden risks. But I'm zeroing in on some of these clues. All right, you read enough news, you remember these little snippets, and you start to recognize patterns here. And here we go in this article, way down here. In a recent survey in the U.S., it was conducted by Bloomberg News for Harris Poll. It found that 43% of those who owe money to buy now, pay later services said they were behind on payments. While 28% said they were delinquent on some other debt because of spending on buy now, pay later platforms. So Mr. CAPTCHA over there, Mr. Traffic Lights, and where's the crosswalks and how many bicycles are in this image? He says 2.4%. Harris Poll says we asked the people with the subprime credit scores, and 43% of them said they were missing payments. Somebody's lying here. And there's more data here. We got this one in CNBC. Americans are going into debt to buy groceries. People are putting food on buy now, pay later. Here's why those balances can be difficult to pay down. And again, it's not the title here that I'm worried about. It's these snippets that I find hiding in these articles. Scrolling way down here. Of those who use buy now, pay later for groceries, 37% of adults missed payments on those loans. All right. Now, this was done by the Urban Institute, this study. So, look, guys, we've got two studies. The one that was done by Harris for Bloomberg said 43% were missing payments. This study by the Urban Institute says 37% were missing payments. But CEO Alex says 2.4% at a time when delinquencies are on the rise in every category. And look, it's up to you guys. Do you believe Mr. Maximilian here, Mr. Max Levchin? Do you think Mr. Traffic Lights is telling the truth about that 2.4% 30-day delinquency rate on buy now, pay later loans? To people with subprime credit scores, these are unsecured loans. There's no collateral to seize if they don't pay. These are people younger Americans who are already in debt, who aren't paying their student loans. Defies logic, these delinquency rates that they're claiming, which means, of course, in my opinion, that there is a wave of defaults coming in this space. So who suffers when buy now, pay later doesn't pay later, when it turns into like take now and never pay? Who ends up suffering? Well, it's funny. I found this article here just a few days ago. Morningstar DBRS confirms credit rating on Affirm Asset Securitization Trust 2024 Alpha. That's a mouthful. What you're looking at here is Affirm, that company, taking this buy now, pay later debt, $1 billion of it, and they're packaging it up into an asset-backed security, a bond, and they're selling it to investors. And oh, by the way, look at this. $790.4 million of this bond is being rated AAA by Morningstar. More than 3/4, almost 80% of debt held by people with an average credit score of 580 to 660 is being rated 80% AAA. It's being sold into asset securitization trusts. And who's buying this? Once again, folks, it is almost always income ETFs, target date retirement funds. In other words, it's pension funds and retirements that are buying this garbage debt. It's the middle class retirement that's going to end up footing the bill for this. Our pensions and retirements is the parking lot for Wall Street's toxic waste every single time. And I would just add, guys, that it's gotten so bad that we had this one back in March, also in New York Post. 15 million Americans, including those making $100,000 or more, are buying groceries with buy now, pay later. And if you assume an average household of 4, you're talking 60 million people are using this to eat. That is how bad things have gotten in the consumer world. And once again, this guy says, don't worry, only 2.4% of the people are delinquent, even though we've got two studies here who are saying high double-digit percentages. That's what I got for you guys.
So, Jack, in kind of, I want to go read all these articles again with a microscope, because as you were talking, I kind of had some ideas about what they could be doing. Like, for instance, he could be, doing things like saying he's only talking about the loans in the securitizations, which at that point, a lot of times what they do is they buy those bad loans out of those securitizations and replace them. The other thing is, what's their charge-off policy? Meaning, like, when do they charge? The banks typically charge off things around 90 days, and that those numbers no longer then show up in a lot of their kind of delinquency metrics. So, that's where there's all kinds of shell games going on. But when you were reading, did you have any were there any clues about how they might be hiding this delinquency?
Here's the thing. They don't even need to hide it, Melody. This is what's so hilarious about that. And the CFPB, the Consumer Financial Protection Bureau, and the Office of the Comptroller of the Currency are starting to sniff out this problem, and they're starting to get in on it. Again, they're going to wait until after the election, probably. Wouldn't want anything to happen to consumer spending heading into the election. But they don't have to report this data. This is the Wild West of garbage debt. And since none of this stuff is reported to the credit bureaus, we really have no access to this data, no way to verify what they're doing, no way to scrutinize these policies, right? There is no transparency whatsoever. And I would add, because of that lack of transparency, the borrower is even more incentivized to not pay it back because it won't show on his credit report. If they don't pay this bill, it doesn't hurt their credit. So it's another data point that makes me say there's no way delinquencies are really 2.4% on these debt. It's probably, if we view it with a consistent metrics that we use for measuring delinquencies elsewhere, I think we're going to find it is astronomically higher than even the credit card delinquencies, which are rising very quickly right now.
One follow-up, Travis, if I could, before yours. So very interestingly, Jack, this past week, I got my hands on a census household pulse survey. In our last segment, I did a whole show on why I thought mortgage delinquency was not, we don't understand the true nature of it. And I talked about Black Knight, who said they had 80% of servicing, and they're showing 1.4 million people as non-current. But this census survey showed over 6 million people when they were essentially being at least 30 days delinquent on mortgages. So that'll probably be a topic we talk about next week. But, when people were asked versus going to these data providers, the delinquency was much higher.
And the data providers are incentivized to put as much lipstick on that pig as possible, right? I mean, that's
absolutely.
Yep. Same thing with the firm.
Yep.
Jack, I hate this, man. I hate it. And honestly, they are required to report the information to the credit bureaus. It's called the Fair Credit Reporting Act. The problem is the FTC isn't enforcing.
Right.
If the FTC would enforce the requirement that they have to report accurate information to the credit bureaus, it would be different. But I've read many articles where the credit bureaus like Experian, TransUnion, Equifax are like, come on, we're ready. Just report us the data. But the CEOs of these buy now, pay later companies are saying, no, we don't want to give you that information because we don't want to hurt our clients because they're in default. And here's the thing that really, it's just the same old crap just over and over again. What I am just gathering from all this is just more awareness on what's going on behind the scenes, because part of consumer spending is debt. Correct, Jack?
Oh, sure. I would argue the largest chunk of consumer spending is debt. And so what we have going on right now, from what I can see, is a situation to where things aren't sustainable. Most people are already out of money. We see that on the reports of the excess savings and the ability to savings as far as the U.S. Personal household savings rate. So the savings is gone. Now the savings has been replaced. That spending has been replaced from savings now to debt. What's very interesting, Jack, is now even that has stopped. We see that in the credit card balances being flatlined. And so that's the point I've been trying to make, is it's not sustainable. It makes sense. Like, okay, we're on phase 1, phase 2, phase 3, but it all comes to the same crashing end. The reason this is different this time, one of the many reasons, is the deficit spending, which I would call inflation, is the inflation this time. And it's absolutely killing people. But I want people to understand that we got to get to the end point. We got to cross the finish line. And that finish line it's a messy finish line. And we see that in a historical context. You run out of savings, you charge debt, you stop paying your debt, things fall apart. And right now we're on, in my opinion, we're on phase 3. People are stopping paying their debt. We see it in the credit cards, and we don't see it in buy now, pay later. Because again, I go back to what I said original broadcast here, is the greed, corruption, and fraud continues to find loopholes. The lack of enforcement from consumer protection bureaus, CFPB, FTC, it's a real issue here. And so, I just go back to telling people hey, you don't have to be part of it. just to the best of your ability, literally listen to what I'm saying. Stop recklessly, spending if you can. And buy now, pay later is a huge problem because unlike credit cards report to the bureau so we can fully understand someone's purchasing power and credit worthiness. Buy now, pay later is just a loophole.
and it's about to be exposed. And just like the new home building scam, and I'll get into that, I think these people are going to be pulled into Congress. I hope they will, and I hope they will be held accountable for the law violations. I mean, do you agree with that, Melly? They are required by the Fair Credit Reporting Act to report this, and FTC, Federal Trade Commission, is supposed to be enforcing it.
Yeah, I don't. So Travis, I know that they've been able to get away with not doing it. I don't know exactly why. So I wouldn't be the person to ask that.
I tell you guys, Congress can't agree on what time it is. So Congress is not going to change the legislation. The only way this behavior will change is if the FTC or one of these regulatory agencies issues some kind of new interpretation of the law that says, based on our review of a law that was passed before buy now, pay later existed, buy now, pay later is subject to this regulation. They haven't done that yet. They've been warning that they're going to do that, but they haven't. And of course, the party in power doesn't want to do anything to disrupt consumer spending now. And I would add, it's again, the lack of transparency. We have no idea how big this thing is because they don't have to report it. For all we know, this is hundreds of billions of dollars. We just don't know. And we know 15 million Americans are using this stuff just to eat, let alone Gucci bags and sweaters and everything else. So this is a huge thing, and there is no metrics. It's a big variable in this equation, and we can't even see it.
What was that dollar amount on that securitization, Jack, that you showed?
It was
again?
1 billion with the ability to raise it to 1.5.
All right. So what I would say, anybody that has time, and I'll be doing it soon, but usually you can get into those securitization deal docs, at least the original securitization, and kind of see what's under the hood there. I think that's definitely something I want to do. But $1 billion, guys, that means this is way bigger than most people think. That is a massive securitization.
And again, the average borrower in that population has a subprime credit score, and they rated it 79% AAA.
Huh. They're trying to squeeze the remaining juice out of the orange. I mean, how are they scrutinizing that
data? How are they arriving at that 79% AAA rating based on proprietary algorithms that they won't share with us? They're hiding behind privacy. They're hiding behind intellectual property to prevent reporting this data accurately.
Right. And it's like another scene from The Big Short where, they go in and talk to the blind lady at the rating agency. Yeah. And that is,
it's sad though. It is sad though. I mean, look at who's paying for this. I mean, the teachers and the firefighters, not the people that should be paying for it. The CEOs, the banks. I mean, our heroes are the ones that are
it and sell it to retirements. That's what they keep doing.
All right. Well, for the sake of time, guys, I got a couple questions. I start here. Oh, I see there's a private chat. My bad. So first one is from Brian Cutsinger. Is higher for longer making buy now pay later an even larger bubble?
I think it probably is contributing because credit card rates are pushing like 30% in some examples. I mean, those are sharecropper rates. That should be almost illegal in my opinion. And so, when you're faced with 30% debt, that does show up on your credit report. And then you could just be like, yeah, I'll click buy now, pay later with no intention of ever paying it back. And they're never going to report it to the credit bureau. And they're not going to come repossess my groceries. Sure. So I think higher for longer is probably playing a role here. And I also think that this is playing a role in skewing GDP higher because this garbage debt is new money being lent into existence that is juicing economic growth in the form of more consumer spending. So it's hiding the pain of higher for longer. It's masking it.
Melody?
Oh, no, I would agree with everything Jay just said. I know.
I mean, I'll come out the gate. I'll say 100%. I mean, it's called quantitative tightening. The more that we are in this period of quantitative tightening, the more people will suffer through unaffordability, and the more they will have to rely on these scams like buy now, pay later to continue their spending. And that's why I'm shouting, like, viewers, please, guys, like, don't be like those people. Don't be like those people. It's not too late. Don't lose hope, right? But be aware. Step one, be aware, right? Now, I got one more question. So sorry. Here we go. Here's a good one right here. I think it's really good because they're bringing up the student loan repayments, but GWAN debt bubble, question mark, when student loans need to be repaid again. Okay, so they're basically saying okay, first of all, people have to pay student loans right now as far as interest payments. So them not making their payments, it's only increasing their balances. But what is a fact is the late payments are not being reported on their credit reports. Again, a violation of law. Okay, although they passed something in Congress making it not. But that happens October of this year, and that's what, like 4 months away. So what are your thoughts there, guys, on that?
You know, I believe it's October is when conveniently just before, or so it won't show up until just after the election, is when the reporting to the credit bureaus of student loan debt becomes a thing again. And while that's going on, a few billion here, a few billion here, a few billion here is being forgiven, even though Supreme Court said what about it? They're just ignoring the SCOTUS ruling on that. But, you know, I heard a very good point on Adam Taggart's channel, Thoughtful Money, recently by Stephanie Pomboy, fantastic analyst. She said, we've now got moral hazard on Main Street and Wall Street. And that should terrify you, right? Moral hazard is when you borrow money or you take somebody's money, you stand to gain from it, but you bear none of the risk, right? So in 2008, moral hazard ran rampant in Wall Street. The golden parachutes, Main Street had to bail them out. And so that was viewed as a moral hazard. And now what you've got is you've got this pattern of doom spending. You've got people taking out student loans with no intention of ever paying them back. You've got people taking this buy now, pay later. And I think a lot of them, probably in the millions, have no intention of ever paying it back. Running up credit cards, no intention of paying it back. Our entire financial system is based on credit. And it is becoming more and more mainstream to borrow money you have no intention of ever paying back. So that should terrify you, because when the people who borrow without any intention to repay outnumber the decent people who intend to keep their word, that's when this whole thing stops working and credit becomes worthless. And I don't know what that looks like, but the whole freaking system is credit-based. So you better believe that's going to be a big problem.
Melody?
Well, it's just interesting because, you know, one of my jobs in post 2006 was just monitoring credit quality, you know, we would look at our entire book. We'd look at the weighted average credit score. We'd look at weighted average loan to value. And you would just see these things deteriorate each month, just getting worse and worse and worse. And what I saw for the first time this last month in my aggregate client books was a credit score decline of 2 points. That it had just been going up or staying the same due to all of this credit score inflation that we've talked about. But what will be very interesting is what happens almost overnight to credit scores when these balances start to be reported, and then their inability to get additional credit is going, you know, they're going to be without options, especially if they were thinking they were going to refinance, or especially if they were thinking they were going to take out one of these Freddie second liens if that program goes forward. And so I think what we're going to see is overnight just purchasing power just disappear.
Yeah. Yeah. And honestly, you know, purchasing power going away is similar to unemployment.
100%.
And we see that happening on a global level with Japan, Germany, and China, right? They have low unemployment and yet are in recession and have price decline with low unemployment. So the show stops. Any last words? Sorry for taking that. Any last words, Jack?
Yeah, 15 million people eating off of buy now, pay later. We've got low unemployment. We supposedly have the best economy ever. This is something is very, very wrong and broken here. And I just got to come back. The mainstream financial press is just bombarding you with empty platitudes about how everything is good and strong and resilient. 15 million people putting groceries on buy now, pay later. Something is very, very wrong out there.
All right, guys. So don't let that be you. And that's a wrap. So our next story is going to be from Melody, and she's going to talk about the hidden warnings in private note sales. And I believe you have some boots on the ground intel to share. I just got back from the beach to share. Melody, is that right?
I do. And I'm going to speed this one up just because we've we're going long here. Travis, you can go ahead and share the slides I have up if you don't mind. So guys, one thing that we've heard about nonstop in housing is the inventory shortage. And I'm going to call this a myth because honestly, I think there's many reasons why I think this is a myth. I wrote about it in a January 23 article, but, we've got 15 million vacant homes. Those aren't abandoned already. They're just sitting out there. Then you have all of this new build inventory. Then you have all of this multifamily, as well as all these new home builds out there that you can't find in these reported numbers. But what I want to say on top of all that is, what if this story is also about NAR, or the National Association of Realtors, losing relevancy in a time of social media, meaning that what this chart that you're looking at represents is not necessarily just the fact that we have less inventory, but it's more that we're listing less inventory on these multiple listing sites that have kind of dominated the industry over time. And so, one thing when I was getting prepared for a debate I did last summer, I looked at pocket listings, something people told me didn't exist. And Inman had done a study where in certain markets, they thought that those pocket listings or listings outside of the MLS were about 25% of the market. Okay. That was, and in places like Austin, a lot more. So I'm saying all this as a preface to the fact that I've also talked about the fact that a lot of the lending moved out to the non-banks from the commercial banks because of those Basel III and capital ratio requirements. What if also, because of all the Dodd-Frank regulations and other things that came out of the 2008 crisis, a lot of those note sales or mortgages actually moved outside of traditional mortgage, even the non-banks. And so you have these things called private note sales, as well as seller financing that I'm going to talk a little bit about. But what's interesting, it's hard probably to see, but to the right of this graph is just a snippet from a Wall Street Journal article that said that, hey, for seller financing, we did a study, Realtor.com, who is, owned by the same parent as Wall Street Journal, and found only 1% of these of sales basically were seller financing. Well, that's what was listed on the MLS. So so essentially what you have, I believe, similar to buy now, pay later, is you have private markets that have sprung up that are much bigger than anybody wants to talk about. And so I went to it's called Diversified Mortgage Expo, a really great group of people. An organizer, Nate Turner, let me come with a press pass. I'm going to give a shout out to Nate, to John and Cindy, the folks that have really been giving me a lot of intel about this market. But I learned a ton. This conference was down in Nashville. And one of the things that I had really been curious about is in this private note sale space, how people were actually doing these private notes. And what I came to find out, which is kind of, was a revelation to me, is that they were actually sitting on the edge of these hedge funds that have been buying up these single family loan sales since the crisis. And so, for instance, Fannie Mae just did one recently. Pretium was the buyer. What'll happen is sometimes these funds will say, hey, I got a whole big tape of loans, but actually, 10 of these loans are not ones that I want. And so these folks in this private shadow market would say, hey, I want to take that off of you. And, my naive self thought that one of the things you wouldn't be able to do when you purchase these pools was to actually sell them off. But in reality, what it seems like is they could sell them. It's just whoever they sold them to would have to abide by the original terms of the agreement, which meant do not foreclose for X number of years, those types of things. So, there's what I'm coming to understand, and there'll be more to come on this story, is that there is an entire market operating out there kind of outside of the eyes of the CFPB. Actually Colony Ridge, the story we did last week, that was seller financing as well. And so the CFPB is getting involved over there. To Travis's point, there are certain regulations everybody's supposed to be that acting in accordance with, but in reality, when you don't have the case law, to Jack's point, you can't really say definitively for something like a buy now, pay later, or even this seller financing. How is it covered under the CFPB? And apparently, the way you can get around this, a lot of CFPB requirements, is essentially you have to have that registered mortgage loan officer helping to originate these loans. So there's a couple of different structures in this space quickly. So the private notes are where folks go out and they try to purchase these notes. And a lot of them have a mission of wanting to actually offer a real modification that would help people become reperforming. Because you talk to a lot of them, and like any industry, there's the good actors and the bad actors. But a lot of the folks that I just met were the good actors. They want to buy up these notes because they are profitable, but at the same time, they can offer programs that the GSCs or the agencies just will not offer. And so they can actually so if anybody ever sees the terms of a 40-year modification, you hope no one you ever know signs up for something like that. And actually, it's not often going to save those homeowners, but these guys can be a lot more creative in terms of, they can before COVID, guys, we could never have done anything like the COVID forbearance. If you were an agency servicer, that would have never been allowed. And so what these guys could do were things like that. And so you could actually get these borrowers reperforming, but this is a big space that nobody can size. So that's kind of the private note space. And then you have the seller financing, where essentially this is, folks doing their own financing because maybe they want to sell to someone who can't actually qualify for a traditional mortgage. Well, that market in 23 was $23 billion. So it is not chump change. No one can actually say how many of these private note sales. There is no one tracking it. And then there is the dark side of the market, which are what we call the sub twos. And this is where they are actually looking out on public record, trying to find out if you're delinquent, if a notice of default has been filed, and they will get your contact information, your marketing information. They will contact you and say, hey, listen, I will take over your mortgage. I'll even pay you back your equity. And I'll make your payments to the company. And so the problem with these, though, is that they're not often recording the deed. And so what happens is that seller or that borrower that's essentially in that home where the mortgage has been taken over until this sub two guy can find somebody to pay off that mortgage, another investor. This is all really kind of complicated. But if that sub two party walks away, you, the borrower, are still on public record as the owner. And additionally, in this country, in the crisis, they came up with these metrics. You can argue whether you think they're legal or not, but legal standing comes from possession of the note, which that sub two guy is never going to have. The bank is going to have, or the non-bank that has lent. So guys, more to come on this, but just at this conference, realizing that this is a much bigger story than most are giving it credit. And I think that it is actually connected to that inventory myth as well. That I think what's happened, that NAR, the biggest lobbyist by spin in Washington, wanted us all to be a little confused about how much inventory was out there, as well as how much relevance they still had in the market. And that, in fact, back in 2015, they had a whole campaign about how they were going to take back, market share with the MLS. And then that all just disappeared. And so what I would argue is that we've probably seen, there's been a lot more transacting in social media than people are actually kind of giving credit to.
I have some. Wait, are you done? I have some questions.
Sure, I'll stop there. Yeah.
Okay, you got me passionate, Melody. You often do. So just to reiterate, I want to make sure I heard you correctly. As far as private note sales, what I heard is they're mostly. I'm going to generalize. They're not trackable. They're highly aggressive and creative. Borderline predatory lending. Is that all correct so far? I know
would
you
say
have to be careful.
well, the bad actors for sure, but there are good actors in this space. Yes.
Okay. Is that type of, I'll use the words, you don't have to, predatory fraud lending? Is that normal? And I have a follow-up question. Is that normal before financial collapses? Fraud and
Absolutely.
reckless?
Absolutely. And what I've heard, I wasn't around for the S&L crisis, but what I heard is that seller financing played a huge role in that crisis as well. And so, it's kind of found its way back.
And I wanted to reiterate what you were saying for the viewers, and I really want them to understand this. We have some questions, but if I have a house and for some reason I agree to sell it to sub two, say they give me $20,000, I'm like, okay, that loan is still under the seller's name and will follow them around for essentially eternity or until the loan is paid off. And I wanted to let the viewers know that the sub two gurus, if you will, or frauds, actually made a video explaining how those investors can commit mortgage fraud to get the seller out from underneath that. And so the whole thing to me, Melly, I just don't understand how come they're not enforcing the existing laws.
Yeah, I think that, what will happen is that as we see, nothing happens until there's a blow up or a crisis. I mean, all Dodd-Frank, all of that came out of the crisis, right? So I believe, we'll start to enter the regulatory cycle as soon as we're deep into the default cycle. And so, once that default happens, then we'll start to get the changes and regulations and laws and the crackdowns. And the fact that the ruling on the CFPB by SCOTA, I mean, there was probably some horse trading involved there for sure, because most people could see like taking the teeth away from the CFPB would be problematic, just because of it would be the Wild West and nobody would know what to do. But I think that the CFPB is going to go on full steroids here. And they will be out because somebody will have to be to blame. And so I honestly think the non-banks will take a lot of that blame. But then I do think these private markets will also be next up for prosecution and more legislation and changing of rules.
Melody,
Can you
could
just
you help me
screen back up?
understand? I'm sorry, go ahead.
I didn't know if, because I interrupted her. Did I interrupt your story? Do you still need your screen up?
No, I don't.
Okay, sorry.
I've heard subject to talked about a lot. I've heard sub two, right? I've heard the door bros mention it. Oh, I got 500 doors, bro. I got 1,000 doors, right? I've heard this a lot. I think a lot of people out there are probably still a little bit confused on how the scam works. Can you walk me through it? Let's say I've got my dirtbaggery t-shirt on and I am one of these scrupulous door bros and I'm just looking to get one over on any sucker who comes along. Without using any industry lingo, it's going to be hard because I know you know this stuff like clockwork. How am I actually screwing the homeowner when I do one of these sub two arrangements? How does that work?
Well, it would depend on the deal, Jack. I mean, there could be multiple ways they could be being screwed out of their equity. I mean, all kinds of things. But the biggest risk, in my opinion, is that this sub two investor walks away and they stop paying your mortgage. If they stop paying your mortgage, then you are on the hook. Your credit score gets impacted, of course. You'll be reported late. You could be taken to foreclosure. They could then, so not only will the home be gone, but they'll pursue deficiency. And that will be on your record, as well as they could come after you financially for any deficiency.
So the sub two lender will say that he's buying the house from the struggling homeowner. He's taking the house. He's assuming the homeowner's existing mortgage, right?
Correct.
But he's not actually assuming the mortgage. He's just pinky swearing that he'll pay.
Correct. Because these mortgages aren't assumable. Like, so this is happening with non-assumable mortgages. You have the FHA and VA where you can do assumptions, but in the conventional space, there's like a crazy one-off program, but these aren't assumable. So you can't assume that note, that promissory note. And so it's like a promise and a contract. And, contracts used to mean things. I think contract law has gotten a little broken since the GFC, especially in this space. So you can't really rely on the contract. These investors are going to walk away.
But the sub two, he takes possession of the home. He takes the deed of the home, or
so he can't take the deed. So I mean, because the borrower, the person in the home doesn't have the deed. Number one,
Right.
Okay, they don't. This think of it as a car title. They don't have it because it's with the bank, and what that is the note. But there's all kinds of creative things they can do that you wouldn't believe it. Jack would be like, okay, we'll take over your mortgage. You can rent from us, for instance. You can stay in the home and we'll pay your mortgage, or you can stay in the home. We'll pay you for your equity until an investor comes along, and then we pay off the loan. I mean, there's so many ways that this can go down. And because there's no regulator looking over these guys' shoulder, like they could put anything in these contracts, any terms they want to put in on these homeowners. And you just never know. But they could walk away and not pay, and then the borrower is on the hook.
Well said. We have a question, and you answered this briefly, Melody. I was hoping to kind of put my 2 cents in there, but the question is are sub two similar to an assumable mortgage? And don't forget, you guys, assumable mortgages was back like in the 70s and 80s. They did away with that because it was crippling to lenders for obvious reasons. The rates were higher and people were just. But here's the thing, and Melody, please correct me if I'm missing anything in here. Essentially, an assumable mortgage is you get permission from the lender to take it over. And
Correct.
Generally, there's a release of liability issue to the seller. Sub two is forfeiting all of the righteous way to do assumable mortgages. Sub two is circumventing the legalities of that. And also, I want to point out, again, like you were saying, that conventional mortgages, almost 100%, do not allow you to do an assumable mortgage. What we're talking about is only a small piece of the pie, which is your FHA, Melody, and your actually even VA. I don't know 100% USDA. I can't remember. I think USDA. I don't know. Anyways, but the thing here is the difference of sub two versus assumable is doing an assumable mortgage is doing it the legal, correct way, where proper liability is transferred to the correct properties, whereas sub two is the benefit almost entirely goes to the investor, and a lot of the disadvantage not only goes to the seller, but sticks. This is the thing. It sticks to the seller. Like you said, Melody, if that investor is late, they get a divorce, whatever the reason is, just one late payment, that hurts. It could be 3 years, 4, 5, 6 years from the date that they sold. If they're late, their credit's dead in the water. And so that breeds lawsuits, that breeds all these other types of things. Going back to the lack of CFPB regulation, lack of FTC regulation. I mean, is this accurate to say, Melody? The differences?
Oh yeah, absolutely. No, I agree. Everything you just said, that the idea is you are not going to be released from the debt obligation, period. That there's nothing they can do to release you from that obligation. And let me repeat that one more time. There is nothing they can do to release you from that obligation until that loan is paid off. Yeah.
You guys
So
get
Melody,
it?
one more question I have on this subject. Aren't there most mortgages, correct me if I'm wrong, there are provisions in there or clauses where if you get caught doing something like this, your mortgage becomes callable, doesn't it? In
Yes,
other words,
it does.
the mortgage company calls you up and says, pay me back everything you owe on this house now. Not
Yes.
start making payments again, but the whole balance suddenly becomes due.
Due and owing. That's correct.
So
Yeah.
you're really sticking your neck on the block here if you're doing one of these sub two loans.
I totally agree. Now, some of the mortgage companies, they're just not set up to just find this stuff themselves. But I guarantee you, as we progress through this cycle and people are upset, people are already, calling out occupancy fraud. They'll start calling this out, and there will be actors that do, activate this clause. It is just such a huge risk, everyone.
Good stuff. You guys have anything you want to end on? I don't see too many questions here about it. More comments. Anything else you want to end on?
No further questions, Your Honor. The melon heads rest.
Okay, well, all right, guys, that is a wrap. Now, the next story is going to be given, if you will, from me. And today's story that I'm going to cover now, guys, is basically the new home construction scheme that's going on right now. And, basically the question that I want to ask is what the heck? I wanted a choice words there because, for children and my own children. But what is going on with the new home data and why? And I think this is a very important thing to kind of focus on, because who do you trust? Where do you go? And I hope that the viewers gain from the story a better understanding of why new home data is so different than the used home. When I talk about cars, we talk about house, existing homes, okay? And I also want, and I'm hoping that the viewers will understand the cons to watch out for. And that's a double meaning there, pros and cons, and then the cons, salespeople. Anyways, so we're going to get started, guys, right now. And what I want to do, first of all, is I want to show you guys, and I want to start by talking about the data manipulation, which is right here. Now, recently I did a tweet, and what I wanted to show the people viewing this is the massive revisions of data and the fact that we really can't trust anyone for anything, and especially when it comes to data. It's almost godlike power. And really what we need to be doing, and I'm just going to give you this right now, is we need to be doing localized analysis of our markets, which means comps in subdivisions, because we cannot trust this data. And towards the end of this presentation, I'm going to show you guys with my MLS. I'm going to access multiple listing service, and I'm going to show you guys that this bottom revision you see here is BS. The top graph right here is a more appropriate depiction on what's going on with new home sales. Plus, I'm going to show you the response that we got from the Census Bureau. We have an email from the Census Bureau explaining these things. But look at this, guys. Essentially, what has happened here is we had massive data revisions, and I want you guys to look at the peaks. The peak in the first data revision, or the first chart, okay? So you guys are looking at new home value, or rather median sales price, which is a horrible indication of value. So the top one is what has been going on for the last, 3 to 4 years. The bottom one is they just decided to change the way they are calculating price groups for median. This is a huge deal, you guys. This is an extremely odd circumstances that is not normal. Revisions are normal, but the revisions that you see here are very abnormal. And I'm going to show you guys that. But first, I wanted to say that the new peak is no longer $500,000. The new peak is now $460,000. That means they made a revision, 2 years old, almost 2 years old revision of $40,000. And in addition, the top graph here, there were 4 months where median sales price was around $480,000. That is all gone. So it's not only the peak that they've revised massive amounts of additional peaks for several other months. So that's all gone. Now, additionally, the top chart shows us 8 months of median sales price being around $440,000. So instead of now 8 months, we have 2 months. Okay. The reason why I'm pointing this out, the reason why I feel like this is so important is because, again, just doing the visual here, they have erased the narrative from our history books, which means 20, 30 years from now, if people go back and see what was going on with new homes, they're not going to be able to see that anymore because they changed the data. And so obviously the next question is why did they change the data? Right. But so far, would you guys agree, Melody, Jack, would you agree that kind of changes the narrative, doesn't it? I mean, one hand on that top graph, we clearly hit a peak followed by a uncontrollable decline in prices. And then they've revised it to say, oh, actually everything's been sideways this whole time. Do you think that underscores, do you think that's an issue, Melody?
Well, absolutely. I mean, Travis, if someone hadn't captured that point in time snapshot that you're able to show here, 20 years from now, no one would even know that existed. I mean, or it would be buried down in a footnote, somewhere. But this absolutely, kind of belies what we saw happen. And we saw, like, the narrative pushing that fear of missing out. We saw Connor Sin, come in Bloomberg and tell everybody to go out and buy a new home. I mean, and so that FOMO, it's as if that, like, I think you've said this on one of your shows, it's as if that FOMO never really existed. Like, to me, this revises history. Absolutely.
And real quick, I want to show the viewers. So first of all, here's the problem as well that I want to point out. The difference between new homes and existing is there is literally no requirement for new home companies to list on MLS. And in fact, they would probably prefer not to list their properties on MLS because it's cheaper for them not to. And so there's really not a lot of incentive. And also think about it, you guys. Realtors that are selling existing homes, what sells at the MLS? For new home builders, they pay money in advertisements, usually commercials. And so that's the way that they generate business normally. So it's not necessarily the MLS. But nevertheless, you guys, I want to show again the viewers how horrible new home data really is. They don't track, you guys, the Federal Reserve, the government, whoever we're talking about, they don't track what's going on with new homes because there's no requirement to report the data. In fact, the data is reported from a silly little survey that is being completed by the actual new home builders. And so, this is very interesting. They actually put a special notice here, basically saying what happened with revisions, which was new price groupings have also been introduced, okay, in our time series file. Now, I'm going to get back to that. I'm just letting you know that there's a brief explanation in here that is absolute garbage. Now, if you're one of the people that thinks that all of the information from new homes is being reported from the census and we're just crazy, then I would suggest do a little bit of research and go to the go to the notes here, and it will state that basically the statistics in Table 1 in this release are based on a non-probability sample and not subject to sampling error. They are, however, still subject, here it is, to non-sampling error. And here's the important part. The total quantity response rate for these estimates is, you guys ready? 76%. What does that mean? It means that there's another minimum, and this is even off, 24% of the data we don't even have. We don't even have 24% of the data. So in my opinion, maybe they should be more worried about, getting more of the data and less about price groups that fit their narrative. But hey, who am I? But let's fast forward to the response. So this is crazy, you guys. So Jason Walter actually, and big shout out to Jason Walter. Jason Walter emailed the Census Bureau and he asked them in so many words, what the hell, right? You made massive revisions. How can we accurately report about the housing market when you can't accurately report the data? So it's an embarrassment. You're to the U.S. Census Bureau, you're embarrassing us. Get your act together, guys. But this is what they said regarding the revisions. This is crazy. It's really the second paragraph, but I'm going to read both. Regarding the revisions, we are applying to the housing unit sold for sale and monthly supply from 2019 to 2024. Okay, so they've made revisions for those 5 years. This is their annual revisions. The annual revision is usually a routine procedure, and we typically apply it during our April report. Okay, so far it makes sense. Okay, now, unlike the monthly revisions we typically apply in the past 3 recent months, these annual revisions are less to do with adjusting the counts for missing and corrected units and more to do with an adjustment to data. I'm sorry, more done to adjust the data to updates, and this is misspelling, to our seasonal factors. So in essence, what they're saying here is we've adjusted our seasonal factors. Okay, and I'm going to read the second paragraph. I'm sorry for mispronouncing that. While the annual revisions exhibited for homes sold, sales, and months of supply are routine, listen, guys, the revision of the sales prices from 2020 to 2024 is unique. It is special. It is different. It is alarming. It is not normal. Something happened. They are acknowledging it. As mentioned to the note on the report, alongside the release of the new residential sales report, we have introduced a version of our sales data with here we go, updated price ranges. They have removed and included additional price groups. You can't do that. We've been tracking the data a certain way for decades, and they've removed that because they can and because it fits their narrative. This goes on in creating these new price groupings. They've created new price groupings. They haven't told us what those are. They haven't told us, is it in every metro? Are you just excluding Austin? Are you now just including Miami? We can't trust you, is my point. So this goes on. It presented us with an opportunity. So this is the Census Bureau, by the way, guys. It presented them with an opportunity to screw us. I'm sorry, that's not what it says. It presented them with an opportunity to re-examine their pricing data and recalculate the prices based on additional data and revisions found since the data were published. But again, what they have done is they just simply created new pricing groups, and what they have done is put different variances of a weight to be put on there. This is absolute criminal. This is absolute criminal. I'm going to. Do you guys have anything there so far? Jack, ask Melly. I mean, what do you think so far about this explanation about because we can and you can't do crap about it? That's how I read that. What do you think, Zach?
When's the last time they made a revision to the data that made them look worse? Them, the people reporting the numbers, them, the party in power, right? We see these adjustments to CPI. Do they ever send inflation higher? No, they always make inflation look lower. We've seen all these after the fact revisions to the jobs numbers to revise it lower, but then of course they don't cover that. So it allows them to lie before the fact and then change it after. The error distributions are always favorable to the bureaucrats reporting the data. And that's the problem, because these data points are too important. Huge decisions, public policy decisions, legislation, people's economic choices are based on this data. And I always use the phrase garbage in, garbage out. If these are garbage statistics, then the decisions being made based on them are going to be equally garbage.
And it is equally garbage. But I asked the question, Melody, and I wanted to, but I'm asking, like, why would they do this? And I'll get to that, Melody. What were you going to say?
Well, I was just going to say one thing I kind of pointed out in my Substack is that, these national builders use these numbers in their models. The banks that give them those huge syndicated loans so that they can build these homes, use those home prices in their models. And so what you're seeing right here on full display is the bezel, which means that essentially, these overinflated prices are what was used to fund lending to the builders. And basically were their earnings erased as well?
I'm actually going to get to that was the why part. Right? Because I thought, okay, well, why would they want to do that? So, to me, the questions, the answer's obvious. They're stocks. And actually, I tracked this back to the day the revisions were made, which was the 23rd of May, which is right here. And first of all, here's Lennar stock. Their stock went up from the date of that revision. Okay, so again, it didn't go up much, but it still went up. You can see that right here. So here was the day of the revisions. It went up a little sideways, and then it kind of started screaming upward. The same thing happened with DR Horton, which is right here. Let me go to the 1 month real quick. So DR Horton, we had a little bit of a low right here on the 23rd. Fast forward to today, the stock's higher. So again, to me, it makes sense. They want to continue the punch bowl. They want to keep drinking the punch. They want to keep tapping people's money. But it's not just the data manipulation, you guys, that really concerns me. It's the overinflation. It's the overvaluation. These homes are overvalued. And again, I want to go to this, and thank you, Melody. Big shout out to you for getting this. This is Freddie Mac. Freddie Mac came out with seller concessionary concerns. And what's happening right now, guys, is a lot of these new home builders are not reporting the seller concessions. They're not. And so many of those homes and homeowners are purchasing homes that are overvalued. And the people that are reselling or selling are also doing the same thing because they've created comps. I'm going to read this report from Freddie Mac that is warning. They have shot a warning shot across the bow of these homeowners. And I'm wondering, is that the revision? Is the revision because they got that warning shot from Freddie Mac and now they've readjusted the values downward to account for seller concessions? I don't know, but let me read this. Payment is made. This is Freddie Mac saying, watch your butt. Okay, so payment is made in terms of cash in US dollars or in terms of financial agreements comparable thereto. And here we go. The price represents the normal, that's the key word, normal consideration for the property sold, unaffected by rate buy downs or 4% interest rate. You remember the rate buy downs? Okay, that are not affected by special or creative financing, it says it here, or sales concessions granted by anyone associated with the sale. And so you guys, they reviewed this. Again, this is a warning shot fired, okay? I think people that are upside down in new homes, they should, actually, I got to be careful saying this because I'm not an attorney, but if I was one of those people, I would be talking to my attorney, like, hey, did they remove the concessions from my appraisal? Oh, they didn't? Well, they don't have QM, Qualified Mortgage Protection anymore, which was the Dodd-Frank Wall Street Reform and Consumer Protection Act, Consumer Protection Act. Get it, guys? Within the appraisal populations, appraisals reported seller concessions in 7.6 million comparables. So you guys, it's not even like they didn't have the info. They had the info, but the appraisers failed to make adjustments on 58% of that 7.6 million comparables. You guys, they aren't calculating value correctly when it comes to new home sales. And this is what I mean by that, okay? Here's Lennar, for example. This is in the Houston market. You know, first of all, look at the price cuts. Okay, so anyone that thinks those graphs revisions, home prices for new homes have just been normal, they have it in Houston. And I'm going to show you MLS. So they have it in Houston. But again, you guys, not only that, this is the problem. This is what's not being reported. This is Lennar offering right now a conventional 3, 2, 1, you're done buy down program. Okay, so they're offering a, listen to this, a rate buy down of 2.25% year one. So they're giving you a 2.25% year one. You guys think that's just putting anyone in a bad situation? Year two is a 3.25. Okay. So buy down rate 2.2 in year one, 3.2 in year two, and then 4.25 in year three with a finalized rate of 5.25%. That's not normal. Okay. They're giving you a special offer. Based on the Freddie Mac guidelines, they are required to remove that from value of comparable sales. It's a requirement. You guys see that right here. Lennar is doing it. If I'm a homeowner, I purchased a Lennar, and I'm not happy, and I can't pierce the arbitration agreement that I'm forced to sign, this is what I'm looking at if it's me. This is what I'm looking at. And I also want to show you guys something real quick, okay? Now, first of all, let me show you my MLS. So what I'm going to do, guys, is I'm going to pull up an MLS. This is MLS right now. I have my realtor license. This is what you need generally to access MLS. I believe that if the public had access to services like multiple listing service, I think that we would be in such better shape. I think it would be so much harder for people to take advantage of us and to screw us and just the greed, corruption, and lies. Give the public the data and don't taint it. Leave it alone. Okay. The MLS is, in my opinion, one of the only ways to get out of the darkness. If you want to be unblindfolded, you have to look at comps. And so what I've done, you guys, is I've done something called a market analysis. And I'm going to save you guys time. Here it is right here. A market analysis analyzes a neighborhood. You guys hear me preach about this. It analyzes a subdivision. Each subdivision is unique. And I also say, if you want to find a great deal, it's simple math. Most deals are not great, though. Don't hold your breath. But if you want to, it is just simple math. You don't have to pay some extravagant fee to join some bozo club to learn how to do this. You just have to add 2 + 2. And I'll tell you the answer, you guys. It's 4, no matter what, 2 + 2. And so what you see here is a market analysis. You see that here on the top. You see, this is a big community, by the way. They sold, and I'm going back to 2022 because that's the peak. Remember the chart we looked at? It peaked at about 500,000 in October of 2022. And so here's the 2022 data for the subdivision that's right down the street from me. There was a total of 380, that's a lot, right? 382 homes sold in just this one subdivision during the year, as you see here, of 2022. I've covered January 1st all the way on to the end of December. This is in the subdivision right here. You guys see, if you are in Houston, check my work by all means. I'm showing you it here. This is in the subdivision called Tavola. Now, you guys, it tells me in 2022 that the average home in Tavola sold for $149 a square foot. Okay. So I've equipped myself now. So I know the average home in Tavola sold for $149 a square foot. And so now that I've equipped myself, now that I can see the data, and this is new home data, keep in mind, so there's missing data here because remember, they don't report everything. So a new home builder in Texas, this is what they do. Texas is non-disclosure. So it's a non-disclosure state. In Texas, these new home builders will sell a bundle of 20 houses, say it's to a fractional owner, whoever it is, they'll sell 20 houses as an example for under 20% under value, 20 houses, 20% under value, and they will never report that data. And because of the nature of Texas being a non-disclosure state, the seller does not have to report how much they purchased the house for. There's a massive lack of transparency, but again, here's the data we need. It's simple math, $149.40 a square foot. So what I'm going to show you guys now is here's the active listings. Okay, so I've accessed MLS. I know $149. That was back 2 years ago. That was 2 years ago. Prices only go up, right? No, they don't. They go down as well. So what you guys see here is all of the active listings in Tavola. There's a total of 57. And what I do, this is the realtor in me. I love numbers. I'm a dork. You guys know that. I just categorize all the active listings by price per square foot. So I know right away what is selling for under market value. And I just wanted to bring your attention to this very first comparable sale. This very first comparable sale is selling for $120 a square foot. What does that mean? That's 20% off the peak. You guys, I'm showing you a house. Live access data. You, by all means, check my work. The very first listing right there is 20% under the peak. Prices are going down despite the revisions that are BS. And I also want to point out this, okay? The first two comps right here, over 15%. First of all, there's about 6 houses right now in Tavola that are 15% under peak, okay? So 15% under peak, there's 6 houses. It's possible to find an okay deal if you know how to do simple math. But here's what's interesting, guys. Take a note of this. Of these first 4 properties, let's say these first, actually, you know what? We'll go to first 5 properties. Of these first 5 properties that are selling drastically under the peak, I want you guys to know that 3 of them are resales. 3 of those properties that are selling for massive amounts under peak are current owners, which means we see right now that in order for current owners of new build communities, in order for them to compete with the builder, they must sell for under market value. And even then, the builder still has enough cushion of profit to still slice your legs out from underneath you. We see that because the first and second comp, it's not a comp yet because it hasn't sold, first and second listing is the cheapest. And those are brand new houses. So there's, I mean, do you guys see the issue here? I mean, you know, in other words, and I'm kind of done presenting there. This is bullshit. Excuse my language. If you really want to know what's going, you got to get the MLS, and the public needs access to the MLS. The MLS is showing the decline. The subdivisions are showing the decline. That revision is nonsense. I just didn't have enough time to do more. I just showed you guys one because we don't have enough time here. I could show you guys several subdivisions right now in Houston. They're off peak by 15%, some listings 20%. And so if people aren't careful, if they're not doing that work, and this is my last warning to people, if you're not putting in the work, don't expect to win. The system is designed to work against you. It's sad, it's frustrating, it's even scary, but it exists. And this is how we have to play the game. And I'm a realtor, and I've showed you behind the scenes how to do this. I've charged you nothing, you guys. You have to do what I'm saying. Maybe you'll be okay, maybe you won't. But if you want the best chance of winning, I'm not a financial advisor, but if you want the best chance of winning, please look behind the curtains. That's my show. That's my presentation. I'm sorry.
So Travis, you know, I think it's excellent when people have this behind the scene data because they can really see for themselves what's going on in their local markets. But as you said, you know, obviously this is only limited to realtors, but do you have access today, for instance, to a Florida MLS?
No, I'm at the mercy of the residents as well. That's the problem.
Right. So meaning that, the system in a way is designed where no one can ever really validate
No,
that
yeah.
aggregate information. I mean, what I found out about a lot of the MLSs is they don't have to syndicate to realtor.com, which is, I'll just keep saying this, realtor.com. That's the data you see on Fred for inventory for sale and also for the median list price. And so there's no way for just a normal human being to kind of validate that information. And we don't know which MLSs are syndicating to realtor and which ones aren't.
Yeah.
And some of them choose not to because they see it as competition. So, if you're a normal person, how can you do this?
You have to listen to what I'm saying. Okay, you need access to MLS. So if you have to play some realtor, I don't give a crap. Go play the game, treat them like crap. Probably you shouldn't do that though. But you have to have access to MLS. And another thing that frustrates me, Melody, is people like, oh, well, it's okay to make revisions. I've got comments like, Travis, you're a fool. They say here they're allowed to make revisions. I never said they weren't. What I said was they removed the entire narrative from the history books. And even their special notes say that this is a unique, and it's infers it's like a one-time thing. But I mean, there's so much tact against consumers, Melody. They got to go they got to go to hell, man. I mean, if you want to win, you got to get burned. I mean, not burned, but you got to get close to that flame. I don't know how else to do it. You got to go boots on the ground. You got to find out for yourself, because anything less than that, you're trusting a stranger to take care of you.
No, Travis, I'm seeing this trend in every corner of finance where they're just terrified of price discovery. They're doing all these sleazy things to hide what things are actually worth. And I want to share this anecdote I got. This was sent to me by one of my viewers over at Nobody Special from the Tennessee area. He's a big real estate investor, and him and his friend, a fellow real estate investor, they were doing some local traveling, just looking at new developments. And he's saying here, entire tracts of developments, they have utilities in the ground, basic roads, etc. Half the lots have sold signs. My buddy and I were driving one of them, and he calls up his friend, who is the builder's agent in this area, calls her up to congratulate her because of half the properties have sold signs. She starts laughing on the phone. We haven't sold a single property.
Yeah.
We put signs out to create urgency. You know how it is. Now, I'm a real estate outsider, all right? I am blown away by how fraudulent that seems to me. Half the properties have fake sold signs. How is that not fake advertising? And then she's laughing. She thinks it's funny, and she's saying, you know how it is. Like, this is just generally accepted practice across the industry. Is this really that common?
It's bullshit. And sorry, it's very common. It's very common. The job of these builders is to get you to buy a house, Jack. And so if you go into a new build community and you see 50 houses with sold sign, it creates a sense of fear of missing out. It creates a sense of urgency. It creates a sense of security, a false sense of security, when the reality is it's nonsense. And Melody,
isn't that textbook false advertising?
You know what?
Sure.
Take it away, Melody.
It's just, so I will give an alternative to Dancing with the Devil, Travis, and that would be, drive around in the neighborhoods where you're curious, where you're interested, where you want to buy, and there's some little tricks like look. So if it's an existing neighborhood, drive after it's dark and look and see, okay, which homes are truly occupied. Also kind of look at which ones are in the midst of what looks like a renovation. It's probably a fix and flip, because this is hiding in existing neighborhoods as well. But to your point, Jack, about this is something we were told by new home sales agents when I first started, all of this, that they salt the lots. And if you go back to these subdivisions at night, I have one right down the street from me, where essentially you can go during the day and it looks like there's like cars parked. At Christmas, there's a wreath, It looks like there's like the little lawn jockeys in the front yard. But if you go in there, but there's always only one little girl that goes down to the bus stop every morning. And if you go in after dark, there is no one home. That's all accessories. And so I asked the same question, Jack, and I think that's the question Travis was asking about the credit reporting. Like we have laws that deal with this. It's just for whatever reason these people don't think they're subject to those laws.
I'll bring up a question or two, but did you want to add anything so far, Jack, to that?
No, thank you. I found that amazing that something that to me is fraud and false advertising is just generally accepted as everybody does it. Seems gross to me.
It is gross. And just like the narrative thing, people are like, oh, I don't know who these people are. I think it's like a bot.
Giving false information to lure people into making the biggest financial transaction of their lives is what's more fraudulent than that?
Well, I mean, are we really surprised that the teachers and firefighters are paying for the commercial real estate meltdown?
Yeah,
so
best economy ever.
We don't have enforcement. There is no enforcement. It's all a game unless you go against the establishment, then they'll come after you, which is our last story. But here's a quick question. This is from G-Wan. Is it only applicable for new builds? I want to look into my area. No, the subdivision analysis is applicable to all properties and subdivisions. The issue, G, is not all properties are located in subdivisions, and that makes it a little bit harder to calculate things like wedge and cash flow and understand trends. And if you're in a situation to where you're interested in a property that is a rural property or is not in a subdivision, generally what the appraisers are doing to calculate comps and value off of comps is they'll take the comparables that are the closest to the property. Now, I will say I've had appraisers go in special situations, go 20 miles away into another city to get comparables. It's very unusual. They did it because there's a special circumstance, which was an ocean view. And so that special characteristic outweighed all of the other fundamentals. But a subdivision analysis is something, or even an analysis, something you should be doing for anything that you want to purchase in real estate. What do you guys think?
Agreed.
You guys think? Okay. And then I have something real quick. Travis, can you pull up older communities that has price reductions, comp sales, same as yeah, easy. I mean, you guys, it takes. This is what realtors should be doing instead of saying, "Hey, just buy a house right now." These doomers are maniacs. Home prices only go up the 10-year cycle. Inventory is not important. Income doesn't matter. Just go buy a house. You guys, you could do this. Doesn't matter. Existing, new homes. The thing that is going to make it difficult for you as a consumer is just getting access to that data. I had to become licensed, and I had to pay a fee, and that's a huge issue right there. You guys have anything else on this one?
Well, I'll just say, so I agree, but there's little tricks you can do. Like, for instance, if you're interested in a property, even in Texas, you can say, pay my property taxes in Google. Just type pay my property taxes, whatever county. It'll take you to the county website. You can put in the parcel number, the address, and what will pop up, because mortgage companies pay most of the taxes. And so they have to be able to access it. It'll pop up and you'll be able to see the assessed values, how that's changed over time. And I actually was able to help somebody recently, Travis, in Texas, because they felt like their realtor wasn't being honest because, history had been erased off Zillow. They couldn't find, what the property had last been sold for. And you could actually get that information from the tax records. And so there's always little tips or tricks. I would just say add us, try to get in touch with us via social media, and we can give you some tips on if for whatever reason you can't find a realtor you trust, or you can't get access to this data, that you can do the best that you can with the limited information that you have.
Good stuff. Jack?
I would just say to people, be real careful with things like those 3-2-1 plans that they were offering. Run the math and look at what your payment's going to be at the end of that expiration. When that last teaser rate expires, what your payments are going to do. If you're one of those, I can always just refinance people, man, ask people who went through that in 2008. That's the dancer scene from The Big Short all over again. No, you can't always refinance, not if you're underwater. So, man, be careful with that stuff.
Something, Travis, too, I'd love to just quickly mention if other people have
You
intel
miss
on
me?
it. That's what?
I said, did you miss me? Is that what you're going to say? Okay.
No. I was going to say what an interesting thing that I just realized the way that the builders are accounting for these buy downs that I had not realized is they're putting them in these demand deposit accounts where they can earn escrow. And so this is how they've been able to afford it. But guys, what if we have that event we're talking about, and suddenly rates go down? They will not be able to earn the money they have been earning. And overnight, those builders' balance sheets, that cash balance, and Lennar has gone out and said several times that they are not trying to build cash. But what if overnight they're not earning that interest on those custodial accounts anymore for that escrow, and it is evaporated? And so, this is how things can happen quickly. And one of the reasons why I think a lot of people couldn't understand why builders still had margin with these buy downs. But this is how you take the money, you put it in an account, and you earn interest on it until you have to pay it. So
Good stuff. Always outdoing me, Melody. I appreciate that. I always like to be around people that are smarter than me, and I'm doing good at it. All right, you guys, that is a wrap. Now, we have something a little bit special today. We're going to put Melody in the hot seat. Now, we're going to do a story number 7. We're going to save the controversial kind of stories to the end. And I just want to do a quick disclosure real quick, and Melody will do it as well. She's going to go into what happened with Trump. This story it doesn't matter whatever political Democrat, Republican, it doesn't matter. Melody is going to point out some concerns she has as it pertains to the legal system. And so that's the story. But again, we're not getting political here. I want you guys to know that you're still going to get hate, Melody.
I know.
Still going to get it.
It's okay. But I feel I think we're all going to take this story really together, right? I'll intro it and we'll all do a couple of minutes round robin on it. But I just, guys, I want to say that as we started preparing for this show and talking to each other, we felt like we couldn't ignore the biggest news story of the week. I got the news while I was at a conference, and I have to tell you, I was pretty shocked. Again, this is not what we want to try and do is give you, factual information and also tools on how to kind of navigate this, because in many ways, I think this is a red herring, an orange herring. It's trying to distract us. It's trying to evoke emotions from you guys, one way or the other, so that you can be distracted with what's actually going on. To the most meaning, the economy, the money you're earning, the money you're spending, that taking care of your family, and your inability to afford a home, your inability to afford groceries. And so these are the things that are most important to Americans when they go and they rate what's the most important thing to them. It's the economy. But what's happening instead is these stories are being, sensationalized to trigger emotion. So you're not paying attention to what's happening to the things that matter most. And so that is why we really felt we had to take the story. We had to discuss it, but we put it at the end so that, if folks didn't want to listen or that they wouldn't have to, because it is a very divisive topic. But guys, the fact of the matter is that this was a creative legal argument, and Trump was convicted on 34 counts. He is now a felon unless that conviction is overturned. So what folks, I think a lot of people believe that even the Republicans don't want Trump as a candidate, and that and again, I can't verify this, but these are things that we're hearing and we're reading, and so we'll share them with you. But that in reality, that a lot of this verdict actually was being pushed by the Republicans, is what some actually believe. And so again, just reporting the facts, and also for just kind of sentencing very close to the Republican convention. So there's a lot going on here that, regardless of how you feel about him, it does feel as if our justice system is again being used and abused to carry out what a small group of people would like to happen versus act as the tool that we need, the judiciary. For our government to work, all of these bodies must be independent. And, the checks and balances, we all heard it, if you grew up watching PBS and, Capitol Hill, the bill, that kind of thing, these checks and balances are important. And it seems as if with this recent ruling that has been compromised. And so, the biggest message there, though, is not necessarily just to get angry and feel disheartened. It's that we have to call our leaders and tell them what is important to us, and that these political shenanigans are not important. That it's more important that we are able to afford a home, a shelter, and to afford, food. And so, again, we couldn't just ignore this story, but our biggest message here is that we need to ignore this story because it is not the most important story out there.
Melody, if I can real quick, it may not be the most important, story out there. The red herring, we talked about all of these types of things, but it definitely made me feel like a caged animal at a zoo exhibit. And the reason why is, first of all, I think if you break the law, you probably should get prosecuted. Okay. So I'm not saying that. If you break the law, you should get prosecuted, but they're not doing that. We just went over how many areas of law violation, and there's absolutely zero enforcement whatsoever. So it's a very concerning thing because it appears that it's political. And that's why it makes me feel like a caged animal. I'm so sick and tired of politics, and it's in sports. I can't even play fantasy football anymore. I stopped playing fantasy football because I'm like, you brought politics into the thing that I escaped it from. And so it's very, very ugly. It's not independent, Melly. It doesn't feel independent. It definitely feels political because, again, we just went over all these, in my opinion, way, way worse situations. And, it feels like we lost our legal system to politics. It feels that way, Melody. Am I wrong to feel that way?
That's definitely what it feels like, Travis. It feels like this is over the top. That we're not focused on what's important, and that this is a lot of, just reminds me of show trials, and it's about sensationalizing this because I think people did a survey and it said if Trump was convicted, would you vote for him? And that changed the mind at least from this particular survey, because the idea that a criminal would be president. But I think that a lot of folks on the other side of it feel very passionately that their election was stolen, and this is going to energize Trump's base. And, he raised $52 million the next day. So these things, tend to backfire a lot of times. And the unintended consequences, and some may even argue that they're intended, could be a lot of, a lot of discord.
Let me start off by saying nobody's above the law. All right. And let me also follow that up by saying that is not a black and white statement, because this is not a black and white issue. We have things like immunity for certain politicians for a reason, so that the justice system cannot be abused for political ends. Mm-hmm. All right. So there is no right answer to this question. Let me just start that out. There is no, everybody's answer is going to be determined based on their personal political leanings. All right. And you can probably guess what mine are. I try not to advertise them too much because I had misgivings about covering this topic to begin with, because, I try to do finance. Now, let me just say that the bar for political prosecutions has been lowered dramatically in this country now, and we don't know the consequences of that. And I think the political left in this country is suffering from a severe lack of imagination right now, because you better believe eventually the Republicans are going to get back in power. And if you think they're not going to lower the bar further, or at the very least operate from this same bar, then you're crazy. So this is a line that can't be uncrossed. All right. Now, the whole no one is above the law thing, really? I mean, what did we charge of? Falsifying business records to cover up a payment to an adult film star for an affair? Like, come on, guys. This is as petty as the Clinton prosecution, the whole thing with Clinton and Lewinsky was. And, you know, hey, maybe Republicans have some searching to do because they made such a big deal out of that. But now what are we left with? We're left with a choice between felony and senility in 2024. And, oh, good, a redo of 2020. Who's ready to relive that year? Who wins here? And that's why I would say the orange herring, because who is winning? These are obviously not our two best choices for president, not by a long shot. Out of 350 million Americans, these two we have to pick between. Who wins? The people who are manipulating the money wins. The military-industrial complex wins. The banks win. That's who's winning here. We lose no matter what. Now, the whole, oh, yeah, nobody's above the law. He committed a crime. He's got to pay. Really, this is the same state where repeat violent offenders are back on the street a day later to commit further violent crimes without bail. This is the state with the defund the police. These are lawless cities that have become degenerate, full of degenerate, violent criminals. Is this really the party of law and order that prosecuted this? And by the way, this is a state's attorney general who campaigned on prosecuting the man. We don't prosecute people. We prosecute crimes. You start with a crime, and then you make a prosecution based on that crime. You don't start with a person and then go find a crime to fit that person. All right. So this is inevitably going to be challenged. It's eventually in the court system, you end up in a 6-3 conservative Supreme Court. So I'm not sure they really thought this out. This is an abdication of power further. It's a further power grab by the executive branch, because these are Department of Justice officials prosecuting these, or state executive branches. It's also placing more power in the judiciary. And we've already got a Congress that has completely abdicated its responsibilities. So the balance of power is thrown out of whack in this country. Because of this, I'd say the executive and the judicial have now taken more power while Congress does what they do best, nothing. And let me just add some more orange herring layers here. We talked about what's going on with our pensions and how we're all being robbed by Wall Street while everybody's paying attention to this. There was something else that happened over the last couple of days. The Biden administration gave the approval for ATACMS missiles to be used against Russian targets inside Russia. Now, Russia has previously said that if we give the Ukrainians these long-range ATACMS missiles that can be fired from the HIMARS that we've given them, that would be a trigger for Russia declaring war on NATO. And Putin flat out said recently that if these ATACMS missiles strike inside Russia, that there will be a nuclear response from Russia. Vladimir Putin is not the kind of man you want to call his bluff. And he has flat out said, if these missiles hit my territory, I will nuke you. And we just gave the Ukrainians our blessing to do that while everybody is paying attention to this silly trial. We are, this was in Doomberg's interview yesterday, I saw on Liberty and Finance. We are sleepwalking into the abyss. And this is the story everybody is talking about. And this stuff is dangerous, guys. And I don't have the solution to it. But I would just close with, we get the leaders we deserve. So ultimately, this is on us.
A couple questions, comments. Melody, here's the first one from RR. How do you feel about this comment, Melody? Keep the peasants distracted and entertained while Rome is burning. Is that a fair comment to make?
Yeah, I definitely think those are the techniques at play here. And I mean, it's just, and keep them distracted and fighting one another is what I would say. Again, this is going to trigger an emotional response from people on both sides. And if you're emotional, oftentimes you're not thinking. And so I would definitely, yes, I would say it kind of accurately characterizes it.
And Jack,
can you go back to that one, Travis? That question, could you bring that back up real quick?
Oh, dude,
did we lose it?
I lost it.
All right, well, that looked like a subtle reference to the Roman poet Juvenal. Right, keep the people distracted. Panamet circuses was the saying, right? Bread and games is basically keep the people distracted. you better believe that's what we're doing right now. Pound them the bread that they gave to the poor people so they'd shut up and stop complaining. There's your stimmies. And circuses, well, this political, you telling me this isn't a circus? I mean, this is the oldest trick in the book. Keep the plebs distracted, give them little bits of handouts, just enough that they stay dependent on you for a little bit more, distract them with some BS, red herring, orange herring, and they'll never notice what you're doing to them.
Okay, I like it. Got three comments. All right, 3 comments, and we'll go. We've been doing this for 3 hours and 15 minutes. All right, so this is from Sheila Grace. Love that last name. Step 1, replace consumer with citizen. Shame on me. I actually want to start doing that. Take 100% responsibility for ourselves. Produce, learn more, understand the system is collapsing, and households can take action. The verdict backfired. How does that comment make you feel, Melody?
Well, guys, listen, I'm not one. I cannot be, if I feel like I can't do anything, I have to do something. And so what I have done personally is I've made a lot of changes in my life. And the one thing that's made me happier in the last 3 weeks than anything else is that we have, planted this garden. And, this is how I plan to combat inflation is I am going to be controlling my food source. I live out with a well. These are things that I'm doing to take back control of my life so that if for some reason, and soon there will be chickens as well. And so if for some reason, eggs become $50, that's not going to impact me because I'll just walk outside and get my own eggs. And the same for, these staples. And then also the other thing is getting to know my community. There are people, around me that they raise beef, they raise cattle. If we can create these neighborhood sort of, cooperatives where we're all working together, we don't have to be, beholden to this system where they just tell us that eggs are going to cost $50 and there's nothing we can really do about it. And so there are things that we can do each day to make it, to take back control and to, reduce our slavery to the debt. And so I think that's what we have to focus on. And it starts locally, just like Jack was saying, we get the leaders we deserve. But in many ways, social media has made us stop talking to one another. It's made us, it's alienated us. We don't, and then we had all these people moving for COVID and now we think that they're not our neighbors. But I guarantee you, if you just go next door, knock on the door, say hello, you're going to have way more in common than you think, even if that person is from the north and you think it's all their fault that home prices have gone up, or they're from California. I guarantee you when the two of you start talking, you're going to have more in common. So please do not fall for this. Do not be a useful idiot. Do not become, someone who's going to act out of anger. Be productive. I say hope is not a strategy. It's an effort. And so, just take the next step in taking back control of your life.
Melody, that was a amazing answer. I would caution you, be careful telling people about those eggs. You don't want people stealing your eggs now. Jack, I got a good one right here for you, man. I actually use this reference. Think of political parties as I don't know, I'm almost verbatim. Look at political parties as WWE wrestlers, Hills versus Babyface, Undertaker versus Hulk Hogan. They're not really enemies. Their job is to tell a story to distract and entertain you. Once the camera is turned off, they're throwing back drinks because they're friends. What do you think about that comment, Jack?
I think if President Biden wins re-election, I think they're going to lower interest rates and print money. And I think if Donald Trump wins re-election, he's going to lower interest rates and print money. And I think no matter what the asset owning class wins here, the inflation class wins. And I think that's probably one of the reasons why gold is sitting here within striking distance of an all-time high, because precious metals investors are starting to see that, and people are starting to move some of their wealth outside of the financial system to protect against that next move by central banks. That is going to happen independent of what happens in November. And, look, again, you can probably figure out where I lie on the political spectrum, but I think conservatives need to hold Mr. Orange accountable. He printed more money, or more money was printed on his watch than any other president. Interest rates were lowered on his watch, creating this inflation. He was badgering the Federal Reserve to lower interest rates to juice his stock market higher because he graded his performance on that. And guys, I don't really see this making that big of a difference, to be honest with you. I think the end result, what really affects most people in their lives, right? There's the silly social issues that we bicker about in the team sport of politics. But at the end of the day, what really affects people's lives is what happens with the finances. And I think the election will not have that big of an impact on that. I really don't.
Okay, because they're not really in charge. Maybe they're just puppets.
It's just theater, as RR is saying here. It's just silly theater.
And just one more comment, Melody, for the segment goes to you. This is from Lisa. The political situations are showing the cracks that have plagued democracy for decades. The problems have existed, but the public has been conditioned to it. Can you touch on that before we end this segment?
Oh, I remember sitting in graduate school 20 years ago and saying, there's going to be a revolution when you just looking at inequality back then. And, I think it's hilarious. I mean, it's not funny, but it's like looking at where we are now is so much worse. And so I think these themes this has been happening for quite some time. It's just now I believe we're at a breaking point and an inflection point because that gap has just gotten so wide between the haves and the have-nots that our social order is being threatened.
Okay, well, good stuff, guys. It was a great report, and that's a wrap. So let's conclude, you guys. I think we want to do a quick, round table, right? Just brief round table. Do you want to start, Jack? Maybe kind of just break down.
Anybody who's still watching, who was here at the beginning and sat through 3 hours and 20 minutes of this, you are a freaking oaf.
You deserve a medal,
you guys. If you made it this far, I love you.
Please.
Thank you, everybody, for your time. Thank you for listening to us. And again, the doom, it's pretty thick here because you don't get it anywhere else because they only give you the empty platitudes. Don't let it weigh you down. All right. There's going to come a time when you wish you had your current set of problems. So don't let it overwhelm you and don't get too dragged down by it. Try to remember to stop and smell the roses.
Melody?
Yeah. So I would just, I agree with Jack. Like there is so much coming at us there. Daily, just what that little knowledge bomb he dropped on me in the show. Because I hadn't seen that story either. I was traveling all day yesterday. I kind of made my heart skip a beat from what I know about that situation. So there is so much coming at us. Every minute we learn something that we would not have thought possible, honestly, a few years ago. So you have to stay steady. You have to be focused on the things that are important to you. And, that's your family, that's your friends, that's taking care of your basic needs. And again, I'm going to go back to my other comment and say, instead of just feeling sick or feeling anxious, go out and start creating connection and start talking to the folks in your community. I guarantee you. And honestly, something I've found in my life is if you go out trying to do kindness for others, you will find the kindness that you need, honestly. So if nothing else, maybe just walk out and say, I'm going to do a kind deed for somebody today. I guarantee you're going to create that connection and you're going to help with all that anxiety.
And I'm just going to throw Lisa's comment up because I share it. My conclusion is we need to slow down and we need to support each other. I hope what the viewers understood during this video is how crooked, how corrupt the data is. It's very difficult as a citizen. I'm going to change consumer with citizen. It's very difficult as a citizen to know what to do next when the data isn't the same. The data keeps changing. And so I would really like to encourage people to learn how the game works and learn how to trust yourself. And in the meantime, if you can, as you're learning, support each other, help each other. That's why we have the Discord community. That's why we're pulling up the comments, because we also, the three of us, want to support you. That's how we sleep at night. That's our motivation. That's why we do these videos the way we do it. We want to support you guys, because I don't want to speak for you, Jack. I know Melody. People weren't supporting us when we lost everything. And that's not a situation that I would recommend anyone go to. I barely made it out. Barely made it out, guys. And I was pat myself on the back. I was a stud back in the day. I was really good at real estate. I still lost everything, you know. Now I'm just an old man trying to make my way through the world. And that's going to do it, you guys, for today. Thanks for joining us for 3 hours and 23 minutes. Melody, do you want to take us out of here?
Yeah, no, thanks everybody for joining. You know, we couldn't do it without you. Your support is critical. And so thank you again. We'll see you again next time. And just remember, math matters.